Hello all my dear students, I hope you all are doing good. So let us start with the second part of full English revision for your CA final direct tax relevant for May 22 and November 22. So in the first session, we have completed the revision of PGPP till the discussion of depreciation, that is section 32, which was one of the biggest section under the income tax law. Now let us go ahead with few more deductions today. So first of all, we are going to start with the specific deductions under section 30 to 36, and then we'll talk about certain sector-wise deduction, and then we'll talk about general deduction. Okay. So the first deduction which we are talking today about is section 30, which talks about what? Which talks about rents, rates and taxes, repairs and insurance of building. So these are the expenditures which are in relation to a building. You will get all these deductions now subject to some conditions which I am going to say one by one. First of all, let us talk about if you are the owner of the building. If you are the owner of the building, means you own that building and you are using that building for the purpose of business or profession, then you will get all deduction except rent. Because if you are the owner of the building, you cannot ask for rent to pay to yourself, obviously. But if you are a tenant of a building, then you will get all the deductions mentioned over here, including the rental expense. Okay. So the owner will get rates and taxes. The owner will get revenue repairs. The owner will get insurance, but the tenant will get rent also along with the other expenses. Okay. The first thing has to be kept in mind. The second thing, rates and taxes. If you want the deduction, I am making an interlinking with section 43B. If you want a deduction of rates and taxes, then the rates and taxes has to be actually paid. It cannot be allowed on an accrual basis. It has to be actually paid by the assessee. Then only it shall be allowed as deduction. Third thing, repairs, deduction of repairs. Now, this is an important point in this particular section. How will we get the deduction of repairs? You will only get, whether you are a tenant or you are an owner, it doesn't matter. You will only get the deduction of repair if it is a revenue repair. Only revenue repairs are allowed as deduction. Capital repairs are not allowed as deduction under this section. Okay. It might be allowed as deduction under some other section. Now let us talk about capital repair. Revenue repair is allowed as deduction under this section. Let us talk about capital repair. Now, if you are the owner of the building, then if you make a capital repair to any building, etc., okay, then in that case, you can add that capital repair to the block of asset and you can claim depreciation on it. There is no harm in that. Okay. So you have a building of 5 crore rupees, you are making 50 lakhs capital expenditure on that. You can add that to the block of asset and claim depreciation. Okay. What about if a tenant makes a capital repair to the building of the landlord? So if a tenant makes a capital repair to the building of the landlord, in that case also the tenant will get the deduction of depreciation, and that capital repair will be considered as deemed building in the hands of the tenant. Actually, that capital expenditure incurred by the tenant is not his building. It is the building of the landlord. He is just incurring an expenditure. So government is using the word, it can be called as deemed building, and then the tenant will get the deduction, and as per explanation 1 to section 32(1) in the form of depreciation. So moral of the story, treatment is same for both of them. Whether the owner makes an addition in the form of capital expenditure or the tenant makes an addition in the form of capital expenditure, both of them will get the deduction. The owner will get deduction in the form of a normal building. The tenant will get deduction in the form of what? Deemed building. Okay. Now, rates and taxes, as I have told you, you'll be allowed only as per 43B, that is actual payment. Make actual payment, take deduction. Next, suppose I am a tenant and you are landlord, and there is an agreement obviously between us. And in the agreement, it is written that if there is any repair to be done, I am not going to do the repairs. Tenant has written that I am not going to undertake any repairs. If there is any damage to the property, it is written in the agreement that tenant is not responsible. So now, this is the clause which is there in the agreement. Now, after a few months, suppose there is some damage in the property and the tenant is making an expenditure of revenue nature to repair that. Will the tenant get the deduction? The tenant will not get the deduction under section 30. Why? Because in section 30, it is written that the deduction of repair is allowed as deduction only if the tenant undertakes to bear the cost of the repairs. And it is written in the agreement. So if it is not written in the agreement and still the tenant undertakes to bear the cost of the repairs, then the deduction is not allowed in section 30. But the High Court has said that if such expenditure is necessary to run the business, then that expenditure can be allowed as deduction under section 37(1). It can be allowed under 37(1). Now, this is a very important adjustment which is there in a proper total income question in your study material. There is a big question in your study material whereby this adjustment is there. So this is what section 30 is all about. Let us talk about section 31. Section 31 talks about what? Repairs and insurance of plant, machinery, furniture. If you make any revenue repair, again, not capital repair, revenue repair on plant, machinery, furniture, or if you take an insurance and where you pay a premium for plant, machinery, furniture, you will get deduction over here. Capital repair not allowed. What about if I take plant, machinery and furniture on rent? Rent is not allowed here. It can be allowed as deduction under 37(1). It is not allowed here. Unlike here, rent is also allowed to the tenant. But here rent is not allowed. It can be allowed as deduction under section 37(1). Okay. Next, now there are certain small deductions which we'll talk about one by one. First one, if you 36 subsection 1 clause 1, if you make an insurance premium against damage of stocks, to protect stocks, you will get a deduction. If employer makes a premium in health insurance premium for employees, but other than cash, it is written over here. It should not be paid in cash. If it is paid in cash, it is not allowed. So if health insurance premium is paid by employer for employee, it can be allowed as deduction over here. Third, if the employer is making a payment of bonus or commission to employee, it can be allowed as deduction. Bonus or commission to employee, it can be allowed as deduction. But this one, the third one, 36 subsection 1 clause 2, bonus or commission to employee is allowed as deduction only on actual payment basis as per 43B. It cannot be allowed on an accrual basis. It has to be allowed on an actual payment basis, not on accrual basis. Okay. Now there is one special point over here. However, where such sum represents profits, then it is not allowed. What do I mean by this? Suppose there is a company, and especially suppose there is a private company, and there is a shareholder who is also an employee. There is a shareholder who is also an employee. And suppose if I am supposed to make a payment to the shareholder of a dividend of 20,000 and a bonus of 20,000. And what I am doing, there is a shareholder who is also an employee. I am making a payment of dividend of 20,000 to him because he is a shareholder. I am making a payment of 20,000 bonus to him because he is also an employee. Now what I will do, I know that the dividend is not allowed as a deduction under income tax law. So what I am trying to do, I am making payment of, I am reducing the dividend amount by 10,000 and I am increasing the bonus amount by 10,000. So I am saying that I will give you dividend of 10,000 and I will give you bonus of 30,000. By reducing dividend of 10, I am increasing bonus of 10 so that I can get more deduction. But the 10 which you are giving in the form of bonus, by withdrawing from dividend and giving that as a bonus, that is nothing but distribution of profits. So if you give a distribution of profit part as a bonus, then that bonus cannot be allowed as deduction under 36(1)(2). What if given as a profit? Instead of giving that as a profit, you are trying to give that as what? As a bonus. Then that shall not be allowed as deduction under section 36, subsection 1, clause 2. That is what this particular section has to say. Okay, I hope it is clear. Next, 36(1)(3), interest on borrowed capital. This is one of the most common section that every business has. This is the one of the most common deduction that every business needs. Interest on borrowed capital. So if you borrow money and that money is used for the purpose of business and profession and you pay interest on that, you will get a deduction. Your capital means money, nothing else. There has to be an element of refund on that. Further, when you say you have to borrow money and use for the purpose of business and profession, the phrase use for the purpose of business and profession is very wider. It means different aspect of the business, different facet of the business. Like you can use for the purpose of purchasing asset also. You can use for the purpose of paying salary, rent, electricity, other operational expenses, so on and so forth. There is no harm in that. Yes, but if you take a loan for the purpose of purchasing an asset, until the time the asset is not put to use, you have to capitalize that interest. That is something which we have done earlier also in the chapter of depreciation. Once the asset is put to use, you have to make it revenue. Okay. Now, does the assessing officer has the right to tell you the rate of interest? That no, you cannot pay 20% interest, you cannot pay 25% interest. Can assessing officer tell you this? That how the hell you can take a loan at 25% rate of interest? The Supreme Court has held that in so many cases. Even High Courts have held that the assessing officer has no right to dictate the rate of interest. He has no right to do that. Okay. Does the assessing officer have the right to tell you that don't take much loan? Loan is not good for business. Don't put yourself in so much of debt. Does the assessing officer has that right? Again, the court has held that the assessing officer should not step into the shoes of the businessman. He has no right to step into the shoes of the businessman and take his business decisions. Whether he wants to take a loan of 60% of the total capital or 100% of the total capital, it is absolutely his wish. Till the time the money is borrowed and it is used for the purpose of business and profession and interest is regularly paid on that, you have to give the deduction of that particular interest to the assessee. Now, certain interest payments are subject to 43B, not all. It means interest deductions will be categorized into two parts. Some will be allowed on actual payment, some will be allowed on accrual basis. I will talk about that in 43B. Don't worry. Okay. Now, there is one Supreme Court judgment of SA Builders. What has happened in that case? The assessee has taken a loan and then that loan is given to what? To its sister concern. So, assessee took a loan, gave to the sister concern and then assessee took the deduction of interest. So, assessing officer disallowed on the ground that the assessee is taking the loan to divert the funds in the name of the sister concern. The matter went to Supreme Court and Supreme Court held that you cannot generalize this particular issue. You have to look into the facts and circumstances of every case. You have to identify what the assessee has done with that money, when the assessee has taken that loan and given to the sister concern, what exactly sister concern is doing with that money. If sister concern is using that money for the entire group as a whole, and it can be considered as for the purpose and business and profession, then it shall be allowed as deduction to the assessee. But if the sister concern is using that money for the purpose of the personal benefits of the directors, etc., then that shall not be allowed as deduction. So you have to look into the commercial expediency of every transaction. You have to look into the facts and circumstances of every transaction, and then identify what do you mean by the phrase that the money borrowed should be used for the purpose of business and profession. You cannot directly say that every fund given to subsidiary or every fund given to sister concern is a diversion of fund. It is absolutely a wrong statement. You have to look into the facts and circumstances of every case. Okay. Now, if I take a loan for the purpose of paying income tax, is that allowed as a deduction? Absolutely not. Income tax is considered as a personal expense, and therefore it shall not be allowed as deduction. If I take a loan for the purpose of paying GST, will I be allowed as that as a deduction? Absolutely yes. See here, this is a very important issue. Now, we are saying about interest in 3613. Is the term interest defined? Yes, it is defined. It is defined in section 2, clause 28A. How it is defined? Interest means any interest payable, and it includes any service fee or any other charge in relation to money borrowed. So, if you are borrowing a money and you are paying interest, that is interest definitely. Apart from that, whatever other charges and service charges and fee and other charges which you are paying in respect of that money borrowed, that can also be called as interest in the language of the law. Now, there is a very important, a famous case of Delhi High Court where the assessee has taken a loan, and after taking the loan, after a few years, the assessee wants to restructure its loan. It wants to reduce its rate of interest. So, the bank said that we will reduce the rate of interest. You have to make one prepayment payment. You have to make one lump sum payment. So, assessee made that lump sum payment of 10 lakh rupees to the bank to reduce the rate of interest, and assessee took the deduction of that 10 lakh as deduction in one single year. That is in the year of payment. But the assessing officer said that the amount which you have paid for reduction of interest, that is 10 lakh rupees, I will allow you that as deduction over the life of the loan, and I will not allow you in 1 year. So this was the fight between the department and the assessee. Assessee was saying, I will get the deduction in one single year of payment. A department was saying, we will apportion that. We will proportionately allow that in the next 10 years. That is over the unexpired life of the loan. And the matter went to Delhi High Court, and Delhi High Court asked, from where the loan has taken? The loan is taken from a public financial institution, that is IDBI. What is this nature of payment? This nature of payment is lump sum prepayment, which is in relation to debt borrowed. So, if it is in relation to debt borrowed, can it be called as interest? Yes, it can be called as interest as per this definition of interest as per section 2, clause 28A. So, if the loan is borrowed from a public financial institution, IDBI, as you can see over here, IDBI is a public financial institution, and what you are making the payment of 10 lakh can be categorized as interest as per section 228A, then it shall be allowed as deduction in one single year. Why? As per 43B. Because in 43B it is written that if you take a loan from a public financial institution and if you make the payment of interest, then it shall be allowed as deduction in the year of actual payment, irrespective of the method of accounting followed by the assessee. Therefore, this 10 lakh can be categorized as interest, and the loan is taken from a public financial institution. Therefore, it shall be allowed in one single shot. That's it. Okay. So, it's a beautiful case. You can go through it once. I have told you each and every aspect of this once. Okay. Next, discount on zero coupon bond. Now, whatever discount on zero coupon bond is given by the company. So, earlier this bond can be issued only by scheduled bank or public sector bank or infrastructure capital company. Now, there is one more assessee who has been included in this, and that is infrastructure debt funds. Now, even infrastructure debt fund after Finance Act 2021, even infrastructure debt funds can issue out zero coupon bonds. They can also issue zero coupon bonds. They have also the right to issue the zero coupon bonds. Okay. Now, zero coupon bonds, what happens over here? I am a company, you are a bond holder, you are an investor. I will issue the bonds to you at discount, and then I will redeem it at par. So, the difference between the discount and the redemption value will be my discount, will be my cost, and that will be allowed as deduction to me over the life of the bond. Okay. So, how it will be allowed? How to compute the life of the bond? Always compute the life of the bond in the form of months, not in the form of year. Like in this example, if your issue date is 13 September 2021 and if your redemption date is 12 September 2026, that is after 5 years, then from this date to this date, you compute months. In that also, if there is a part of the month, that is the month is not complete, then if there are 15 days or more in that month after the issue, then you take that as a complete month. And if there are less than 15 days in that month, then you have to ignore that month. So in that case, here on 13th of September, I am issuing the bond. So 13th September to 30th September, there are more than or 15 days or 15 days or more. 15 days is also fine. Less than 15 is ignored. 15 or more than 15 is considered as a complete month. So you have to consider this September month also. So September, October, November, December, Jan, Feb, March. First year, you will be having 7 months. Then the next 4 years, you'll be having 12 months. And in the last year, you'll be having 5 months because 2026, you'll be considering April, May, June, July, August. You will ignore September. Why? Because in September, there are less than 15 days. So in this way, you will get 60 months. So how will you compute the discount per month? The total discount divided by 60 months, and this will be the discount which will be allowed to you as deduction every month. Now multiply in first year by 7, in the next 4 years by 12, and in the last year by 5 months. I hope it is clear to all of you. Okay. Next, the next 4 deductions are absolutely critical. The first one, 36 subsection 1 clause 4. If the employer makes a contribution to a recognized provident fund, not unrecognized, recognized provident fund or superannuation fund of the employee, then it shall be allowed as deduction to the employer subject to 43B. It means it will be allowed on actual payment. Second, if the employer makes a contribution to employees approved pension fund, then it shall be allowed as deduction to the employer as deduction and subject to 43B. But there is one threshold also over here, that the deduction cannot be, the contribution should be less than equal to 10% of salary, and the salary over here means basic salary and DN terms. It means here there is another restriction, that is the restriction of maximum contribution. Suppose if the salary of the employee is 30 lakhs, then the contribution cannot be more than 3 lakhs. If the contribution is more than 3 lakhs, the deduction will be restricted to 3 lakh rupees. Suppose the salary is 30 lakhs and the contribution is 4.5 lakh, the deduction given to the employer will be 3 lakh rupees, that is 10% of salary, that is basic plus DA. Next, employer 3615, employer's contribution to approved gratuity fund is also allowed as deduction, but again subject to 43B. Now these 3 deductions are employer's contribution, and the next one is employee's contribution. So in 43B, by when you have to make the payment? In 43B, you can make the payment till the due date of filing of return. It will be allowed as deduction. You need not have to make the payment during the financial year itself. So financial year 21-22 is relevant for our exam. You can make the payment till the due date of filing of return for financial year 21-22. Now 3615A, now very critical. 3615A talks about what? Employee's contribution. I am an employer, I am deducting some amount from your salary and then making the payment to the relevant fund. So when I am deducting that amount now, at that moment, that amount is considered as my income under section 224 subclause 10. So employer's income, it is considered. The employee's contribution, listen the words carefully. Employee's contribution is first considered as an employer's income. And then if the employer make the payment before the due date, then it is allowed as deduction. So now there is a lot of confusion which was going on across the country, that the employee's contribution has to be made the payment as by which date. So there were different high courts which were saying different things. Some high courts were saying employee's contribution can also be made as a payment till the due date of filing of return. But some high courts were very strict who were saying that employee's contribution has to be made as a payment only by 15th of the next month. That is the due date which is mentioned under the Provident Fund Act. I hope if you practice, you might be knowing that the due date mentioned in the Provident Fund Act is 15th of the following month. It means the December contribution has to be made as a payment by 15th of Jan and not by due date of filing of return. So there was a lot of confusion regarding this. Some high courts were saying you can make the payment till due date of filing of return for employees' contribution. There is no confusion regarding employer contribution. Employer contribution has to be made as payment till the due date of filing of return. There is no second thought, there is no contradictory judgment. But for employee contribution, there were 2 thoughts. Whether I should make the payment by next of 15th of next month, sorry, or whether I should make the payment by due date of filing of return. So Finance Act 2021 has made a clarification, and it has said that 43B is not applicable for employees' contribution. An employee's contribution has to be made as a payment as per the fund's due date, and the fund's due date is 15th of the following month. So there is no second thought now. Employees' contribution has to be made as a payment as the fund's due date, that is by 15th of the following month. I hope it is clear to all of you. I'll be speaking about that again when I'll be speaking the discussion of section 43B. Next is a very simple section. If you have an animal in your business and which is not as a stock in trade, but other than stock in trade, so you will get the deduction. But when you will get the deduction? Listen carefully. You will get the deduction in the year in which you sell the animal or the animal becomes useless, and that year you will get the deduction. You sell the animal is dead or useless and you sell it. In that year you will get the deduction. You will not get the deduction in the year of purchase. Be very careful. You will get deduction in the year of sale, in the year in which the animal is useless or dead. And how much deduction I'll get? You'll get the deduction as cost minus sale value. Suppose you have bought the animal for 30,000 and now the animal is useless or dead. You are selling it for 2,000 rupees. So 30,000 minus 2,000, 28,000 will be allowed as deduction to you. Okay. I hope it is clear to all of you. Next one is a very important deduction, bad debts. Deduction of actual bad debts, not provision for bad debts. Actual bad debts, actual, not provision. So how will I get the deduction of actual bad debts? So you have to fulfill 2 conditions. First, you have to write off that debt in the books of accounts. You have to write off that debt in the books of accounts. And second, the debt which is writing off, it must have been taken into income earlier. It must have been taken into income earlier. Then only the deduction is allowed. Condition number 1, you have to write off that in books of account. And condition number 2, you have to take that into income earlier. But for bank, there is an exception. In case of bank and money lending institution, the loan amount which they give, that is the principal amount. The principal amount which they give, that cannot be taken into income earlier, na? Because that is a balance sheet item. Now, interest income could have been taken into income earlier. but the loan amount cannot be taken into income earlier. Therefore, in that case, there is an exception that this condition is not applicable for banking and financial institution. For them, only one condition is applicable, that is they should write off the debt in the books of accounts. That's it. So suppose I am a bank, I am giving you a loan of 10 lakh rupees and that is bad. So I will write off that 10 lakh, I will take the deduction. I need not fulfill condition number 2 because that cannot be fulfilled. That cannot be taken into income earlier because that is a principal amount, not interest amount. Okay. Now, is it necessary for me to establish the fact to the assessing officer that my debt has become bad? Am I supposed to give proof to him that my debt has become bad? No. As per the Supreme Court judgment of TRF Limited, it is held that it is not necessary for the assessee to establish the fact that the debt has become irrecoverable. Not necessary. बिल्कुल भी जरूरी नहीं है assessee को ये बोलना कि डेट क्या हो चुका है, बैड हो चुका है, बिल्कुल भी बोलना जरूरी नहीं है. ठीक है, ये सिर्फ बुक्स ऑफ अकाउंट्स के अंदर यू हैव टू राइट इट ऑफ. You have to just write it off in the books of accounts. That's it. You need not have to prove the fact that the debt has become bad, etc., etc., etc. Okay. Now, will I get the deduction of provision for bad debts? Under this section, you won't get any deduction for provision for bad debts. Yes, later on in 3617A, you will get the deduction of bad debts. Provision for bad debts only for banking and financial institutions, not for everybody. Okay. Next, there is an amalgamating company and there is an amalgamated company, and the amalgamating company has sold some goods. And then the company got amalgamated with the amalgamated company, and then the amalgamated company's hand, that debt is becoming bad. Will the amalgamated company get the deduction? Yes, as per Supreme Court judgment of 1985, in the case of T. Veerabhadra Rao K. Koteshwara Rao, it is held that the deduction, the goods sold by the amalgamating company, which has become bad in the hands of the amalgamated company, shall be allowed as deduction. It shall be allowed as deduction. Don't worry about it. Next and the last one. This is a big one now. This is a big one. Listen carefully. Now the government of India has brought ICDS, we all know that. Now in ICDS, what happens? There are certain incomes now which are considered as income as per income tax, but not income as per accounting system. It means in accounts, the revenue recognition accounting standard does not allow recognition of revenue, but tax standards, ICDS tells that, recognize that. So now there is a disparity between the accounting system of tax and accounting system of accounts. So there are certain incomes which are recognized as income under tax, but not recognized as income under accounts. So suppose if those kind of income becomes bad after a year, and if I want to take a deduction of that particular income, one of the conditions which I have to fulfill is I have to write off that debt as income in the books of accounts. Now, when I talk about this condition, I cannot fulfill this condition because to write off that income as bad in my books of accounts, I should have recognized that first in books of accounts. Now, such income is not recognized only in the books of accounts because 1 year back, there is an income of 1 lakh which got recognized in tax, but it did not got recognized in accounts because of the revenue recognition accounting standard. So if such incomes become bad after a year, how will I fulfill the condition of the debt should be written off in the books of account? How will I fulfill that condition? So to overcome that, the government has said that, the government has put a proviso in section 3617, and they have said that if there is certain debt which is recognized in tax but not recognized in accounts, and if that becomes debt, then it shall be deemed that such debt is written off in the books of accounts. The government is putting the word deemed to have a fiction over here that don't worry, such debt is also deemed to be written off in the books of account so that the assessee can claim deduction on that. Actually, check. Is it clear to all of you? So beautiful, beautiful amendment by Finance Act 2015. Next, 3619, expenditure on promotion of family planning amongst employees. Now, this deduction is only allowed to companies, not to other assessees, only companies. And it is allowed fully as revenue. If it is a capital expenditure, then it will be allowed in 5 equal installments, not in one shot. So there are 3 things which you have to keep it in your mind. This deduction is only available to companies. It is allowed fully revenue. And if you are incurring a capital expenditure, then you will be allowed the deduction in 5 equal installments. Further, if there is any loss because of the capital expenditure, listen carefully, not because of the revenue expenditure. If there is any loss because of the capital expenditure, then that shall be treated as same as UAD. It means it can be carried forward for infinite number of years, and it can be set off against any income except salary. Now, after some lectures, there will be a lot of confusion in your mind because this is a very early stage of your CA final direct tax. When your entire revision will be completed, there will be a lot of confusion. Obviously, as the subject will pile up, confusion is bound to happen. So now, let me tell you one thing very clearly here itself, and that is, here, this is a section where the word company has come. Now, there are a lot of sections where company will come. There are a lot of sections where it is written that this deduction is only company specific. So after few lectures or after completing entire business and profession, how will you identify that? How will you identify? There are a lot of sections where it is written that this deduction is only available to manufacturer. There are a lot of deductions where it is written, this deduction is allowed to the extent of what? 20% of profit, 60%. How will you identify? There will be a lot of confusion. So don't worry about it. Okay, we have done an exercise for you all. Let me show you here itself. See, now this is the interlinking of the entire subject. How interlinking? These are the three sections under income tax law where manufacturing or production will come. Only three sections, out of which one we have done, that is additional depreciation. Rest of the two we will do later. These are the only four sections under income tax law where the company will come. These are the only four sections under income tax law where Indian company will come. These are the 6 sections under income tax law where amortization will come. Amortize, like in 3619, just now 1/5 of capital expenditure. These are the sections under income tax law where the deduction is based on certain percentages. These are the deductions under income tax law where there is some lock-in period. And these are the deductions under income tax law where there is a question of new plant and machinery to be purchased by the assessee, out of which one is done. That is the additional depreciation part. I hope it is clear to all of you that how beautifully the book is designed. You will not get such book with great interlinking in the entire country. Let me tell you very clearly. So download this book and start studying from this book. That's it. You don't have any other option. Okay. Now let us go ahead with STT 36115. Deduction of STT. Yes, I will get deduction of STT if my income is classified under business and profession. But if my income is classified under capital gains, deduction of STT is not allowed as per 7th proviso to section 48, which we'll be doing in the chapter of capital gains. But I'm just doing an interlinking here. In capital gains, it is not allowed. But in PGBP, it is allowed. If you trade in securities and that is treated as a PGBP income, it can be allowed as deduction. Don't worry. Okay. Similarly, CTT, commodity transaction tax, is also allowed as deduction if you are a trader in commodity. If you are a trader in commodity, you will be getting the deduction of that under the head PGBP under section 36, subsection 1, clause 16. Okay. Next deduction is especially for cooperative society who are engaged in the manufacturing of sugar. So a sugar manufacturer would require sugar cane. So this deduction is especially for only for cooperative society. Like this deduction is only for company. This deduction is only for cooperative society. So what kind of deduction is this? Listen carefully. So cooperative society who are engaged in the manufacturing of sugar, if they buy sugar cane at a price equal to or less than the price fixed or approved by the government, then only it is allowed as deduction. So they have to buy the sugar cane at a price fixed by the government or at a price lesser than that. If they purchase at a price low more than that, then it shall not be allowed as deduction. Okay. And one last thing over here, 36.118, read with section 48.13, 36.118, read with section 48.13, which talks about mark to market loss. If there is any mark to market loss, it shall be allowed as deduction, but only if it is determined as per ICDS. If it is determined as per ICDS, the government will allow mark to market loss also. But if it is not as per ICDS, the government will disallow that under section 48.13. So this is what this topic is all about. Once go through it and then we'll move on to the next topic. So now let us go ahead with the big one now. Big one, that is sector-wise deduction. Here we are going to do all the deductions of sector-wise nature one by one. The first one, one of the most important, one of the most biggest one for your exam in CA final. The ICI has asked this particular deduction a lot of times in the exam. Okay. So first one is 33AB, which talks about assets you are engaged in growing and manufacturing, growing as well as manufacturing tea, coffee or rubber in India. Now there are various aspects. We'll talk about one by one all of them. Suppose if an assessee is only engaged in growing tea, coffee or rubber in India, only growing, then the income is fully exempt as it is an agricultural income. If an assessee is only engaged in manufacturing, then the income is taxable. But if the assessee is engaged in growing as well as manufacturing, tea, coffee or rubber in India, then 4 sections are relevant for assessee. First, section 33AB. Second, rule 8, rule 7A and rule 7B of income tax rules 1962. Third, explanation 7 to section 43.6, which we have already done along with depreciation, whereby it is written that where your partial business is agricultural and partial is taxable, then it is deemed that your entire business is taxable and the entire depreciation will be reduced from the block, and not only the taxable portion. The entire portion of the depreciation will be reduced from the block of asset. This is something which we have already done. And fourth is the definition of plant, which tells that plant excludes tea bushes because you already get a kind of deduction over here in section 33AB. So today's session is more importantly for these two, and in that also more importantly for the first one, that is section 33AB. In 33AB, what is the deduction? The deduction is available to assessees who are engaged in growing as well as manufacturing. You have to do composite activity. growing and manufacturing tea, coffee and rubber in India. Now what is the deduction? What the assessee has to do? Assessee has to do the following things. First, assessee has to go to NABARD or any other government approved bank and deposit an amount over there. Assessee has to go to NABARD and any other government approved bank to deposit an amount over there. By when the assessee should go? The assessee should go within 6 months from the end of the financial year or before the due date of filing of return, whichever is earlier. The assessee has to deposit that amount before this particular date. Now, how much deduction the assessee will get? The most important one. The assessee will get deduction of an amount deposited compared with 40% of PGBP income. So, amount deposited will be compared with 40% of PGBP income, and that PGBP income will be before this deduction, obviously, and before setting off brought forward losses of earlier year. So, that PGBP of which you are going to take 40%, that has to be before this deduction and before the brought forward losses of earlier year. And then you have to compare the amount deposited with 40% of PGBP, whichever is lower will be allowed as deduction. Now, what should be your hierarchy while solving the sums? Listen carefully. The first thing, suppose you have been given with the PGBP income. You have been given with brought forward losses of earlier years. Now, how you are going to do the sum? Suppose it's a tea wala case or rubber wala case or coffee wala case. The percentages change in that. So, let us assume that it's a tea wala case. In tea, it is said that as per rule 8, 40% is taxable and 60% is exempt. That is agriculture, which is written over here. You can see over here for tea. What is the tea? The classification for tea, 40% business, 60% exempt. There's a different classification for rubber, and in coffee, within coffee, there are two classifications. So let us talk about that. It is tea. So how you will do the sum? Suppose there is a PGBP income which is given to you, brought forward loss which is given to you, amount deposited which is given to you. So what should be the order of the sum? First of all, you will write PGBP and then you will reduce the amount deposited compared with 40% of PGBP, whichever is less. It means out of PGBP income, first thing which you will do is you will take deduction under 33AB. Then whatever amount will come, you will not reduce loss now. Then you will apply rule 8, rule 7A, rule 7B. You will take 40, 60, 65, 35, 25, 75, whatever the case it is. And then whatever is the taxable portion, out of that you will reduce the loss. This should be the order of the sum. You can go to ICS study material or my textbook, my question bank, wherever you want to see, you can see such kind of format for which you are going to get the marks. If you change the order, the entire sum will go down. Be very careful about it. Okay. Now, what about future? Once I deposit the amount, then I'll get the deduction. Then am I supposed to do with that amount something in the future? Yes, you are supposed to do something with that amount in the future. What is that something? Can I withdraw that amount? What are the consequences of withdrawal? And if I withdraw, where should I use that amount? All these questions have to be answered over here. The first thing, can I withdraw that amount? Yes. If you withdraw that amount will be taxable. But in some cases, it is not taxable. Let me tell you. If you are dead, if the assessee is dead, if there is a partition of HUF, or if the company is in liquidation. Assessee is that partition of HUF or the company is in liquidation, then the amount withdrawn is exempt. But if you close your business deliberately and dissolution of firm, it is taxable. In these two cases, it is taxable. In 3 cases, it is exempt. The amount can be withdrawn in the following circumstances. Total 5 circumstances, out of which 2 is taxable, 3 is exempt. Okay. Second, if I withdraw the amount, what am I supposed to do? The moment you withdraw the amount, you have to utilize that amount in the same previous year for specified purpose as it is written over here. If it is not utilized in the same previous year, suppose you withdraw 10 lakh rupees out of the NABARD fund, you have to utilize in the same previous year. If you do not utilize in the same previous year, then that amount will become deemed income, but the taxable portion will only be 40%, 35%, 25%, which is taxable over here as per rule 8, rule 7, and rule 7B. Be careful about it. I have said you about this in the logic of this in the class, the why it is so. You can have a deep thinking at your end that why it is so. I am not in a position to answer that logic over here. I don't have much time to explain that. This has to be a very fast revision for you, so that on the day of exam, you need to revise the entire subject. Your dream of revising the entire subject on the day before exam in CA final DT will be fulfilled by me. Don't worry about it. That a student can only dream about revising the entire DT before exam. It's not possible in 1.5 days to revise the entire subject, but your dream will be fulfilled by me. Don't worry about it. I am there for you. Okay. So, when you withdraw the amount, you have to utilize in the same year. If you do not utilize in the same year for the specified purpose, then that will be deemed income. How much will be deemed income? 40%, 25%, 35%. Okay, fine. Now, if I withdraw an amount of 10 lakh rupees, say from NABARD, and I do some expenditure out of it, say salary expense, will I get a deduction of that salary expense also as PGBP expense? You will not get, because this will amount to dual benefit. Because when you deposited the amount, you already took the deduction. Now, after withdrawing that amount and incurring an expense, you are not doing any favor on government. So, you are withdrawing that same amount on which you have already taken deduction in earlier year. So, you are withdrawing that amount and you are putting that money where in the form of an expenditure, says to give salary, to give electricity rental expense, and you are asking for that expense again. You will not get the deduction. Please be very careful about it, because this will lead to dual benefit, and the government is not intended to give you any kind of dual benefit over here. Okay, next. If you withdraw any amount, can I withdraw the amount and buy some assets? Yes, you can buy some assets, but some assets are prohibited. Do not buy them. Please keep those assets ka list in your mind. Which are those assets? Do not buy plant and machinery which is installed in office, residential accommodation or office appliance, not being computer. It means you can buy computer. There is no harm in buying computer. So you should not buy plant and machinery which is installed in office. You should not buy plant and machinery which is installed in residential accommodation or office appliance. You can buy computer, you can buy land, you can buy building, you can buy furniture. There is no harm. These are the few assets which are not allowed by the government. If you buy them, then you are making a violation. If you are making a violation, deemed income. Whatever deduction is claimed earlier, deemed income. Okay. Now, once you buy the asset, say you bought a land for land out of the amount withdrawn. Now you have to keep, you have a lock-in period on that. You cannot sell that land for a period of 8 years or otherwise also transfer for a period of 8 years. You cannot do that. You cannot sell or otherwise transfer that land for a period of 8 years from the end of the financial year in which the land was acquired or in which the asset was acquired. Yes, there are two exceptions in which you can sell. First, you can sell to government or local authority. Second, you can have a succession of a firm to company. If a firm is succeeding into company and transferring the assets within 8 years, it is allowed. Provided in that also there are three conditions which are not mentioned here, but I am saying you. All the partners has to become the partner over there. All the assets, all the partners have to become shareholder over there. All the assets has to be transferred over there, and all the liabilities have to be transferred over there. Then only you will get the relaxation over here. Otherwise, the firm has to bear the brunt of the deemed income. Okay. Next. Now let us talk about these rules. These rules are very important for you. If you are engaged in growing and manufacturing tea, 40% business, 60% exempt. If you are engaged in growing and manufacturing rubber, 35% business, 65% agriculture. That is 65% exempt. If you are engaged in growing and manufacturing coffee, then there are two types of coffee. A normal coffee and a very, very, very high premium coffee, grown, roasted, cured, etc. So this normal coffee, 25% business, 75% agriculture, and this one, 40% business, 60% agriculture. You have to be very careful while looking at the question when it is about coffee. Because you have to see whether it is a normal coffee or whether a lot of adjectives and adverbs are added to it. Like it is mixed, it is grown, it is cured, it is roasted, etc. etc. If these adjectives are added to it, it means it is a premium coffee. In Hindi, we say it is a manga coffee, expensive coffee. Okay. Fine. Now, this is what this first section is all about under sector-wise analysis, a very critical section it was. The second section is very, very straightforward. It is similar to the previous one. 33 ABA. This is applicable. This section is also called as Site Restoration Fund. It is applicable to associates engaged in prospecting, extraction and production of petrol or natural gas in India. So now everything is same over here except some conditions which are differentiating. Let me tell you the differentiating point over here. First thing, here you are going to deposit to NABARD, not to NABARD but to SBI. First thing. Second, here the time limit is slightly stricter. There the time limit was 6 months on the end of the financial year or due date of filing of return, whichever is earlier. Here it is before the end of the financial year. Okay? Before the end of the financial year, you have to deposit the amount. And here the percentage is 20% instead of 40%. Apart from that, everything is same. Everything when I say this is same, 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 and this is same. Everything means everything is same to same as section 33AB. So I'm not wasting much time. I'm going ahead with the next section. And next one is what? Next one talks about scientific research expenditures. So there are 7 sections over here in all. Section 35 subsection 1 clause 1, section 35 subsection 1 clause 2, section 35 subsection 1 clause 2a, section 35 subsection 1 clause 3, section 35 subsection 1 clause 4, section 35 subsection 2a, section 35 subsection 2ab. These are the 7 sections which we are going to do one by one. Now first of all, we are going to do 35.11 and 35.14. So in this particular section, in these two sections, 35.11 talks about revenue expenditure deduction and 35.14 talks about capital expenditure deduction. And in both the deduction, in both the section, you will get the deduction of pre-commencement expense also. So pre-commencement expense up to 3 years from the date of commencement, whatever pre-commencement expenditure you have done, you will get the deduction of that also in the year of commencement. 100% deduction. Suppose today the business is commencing, so mark this date as a cutoff date, and from this date go back 3 years. Whatever revenue expenditure you have done, you will get the deduction. Whatever capital expenditure you have done, you will get the deduction. So whatever, let me tell you very clearly, it's not whatever. There are some expenditure which the government has defined. So revenue expenditure, you will get salary, you will get purchase of raw material, 100% approved by the Director General of Income Tax. In case of capital expenditure, you will get all capital expenditure except land. The period I have said you for 3 years. You will get all capital expenditure except land. You will not get the deduction for land. So what about post commencement? In post commencement, you will get any revenue expenditure, any. There is no restriction. In post commencement, you will get any capital expenditure again except land. Except land. 100%? Yes. Here in post commencement, if you are covered under section 35 subsection 1, you are incurring a revenue expenditure for a scientific research department in your business, then you will get 100% deduction for revenue expenditure and also for the capital expenditure. You buy any kind of plant and machinery, furniture, building except land, you will get 100% deduction if you buy that plant, machinery, building, furniture for the purpose of scientific research in your business. You will get 100% deduction. This is the beauty of this particular section. Then will I get depreciation? Please don't ask for that. Please have some courtesy in life. Okay. You are taking 100% deduction of plant, machinery, furniture, building. How the hell we can ask for a depreciation on that particular machinery? This will lead to dual benefit to the assessee, and the government does not intend to give you dual benefit at this moment. Okay. So this is the first section. The second section. Second section 35(2)(ab). This is exclusively applicable only to companies and companies who are engaged in manufacturing any article or thing other than certain products mentioned in 11th schedule of Income Tax Act, or the assessee can also be engaged in the business of biotechnology. So this deduction is exclusively for company and those companies who are engaged in manufacturing of any article or thing other than 11th schedule items, and they can also be engaged in biotechnology business. The assessee should do in-house research, and this research should be approved by the government of India. There has to be an agreement. This deduction is not available for land and building. For land and building, you can go over here. For building, you can go over here and take a deduction. But for land, there is no deduction under income tax law. For building, you can take deduction 35(1)(4). For that, this deduction is only for post-commencement business, not for pre-commencement. Apart from that, you will get a deduction of 100% of all revenue and capital expenditure, 100% deduction. Okay? You will get 100% deduction for all revenue and capital expenditure. Now coming to the next one. Next one is what? These are the 4 different sections whereby you are making now donations. You are making donation. If you have a PGBP income, you can make donation to other institutions who are engaged in scientific research, etc., and you can claim deduction. So 35(1)(2), you can make donation to certain college, university, etc., who are engaged in scientific research, 100% deduction. Like ATG you do. Here also you can take deduction. Here you can do deduction to certain institution, college, universities who are engaged in social science, statistical research, 100%. You can give donation to National Laboratory, IIT, 100%. You can give donation to Indian companies who are engaged in scientific research, 35(1)(2), 100%. All must be approved. And once you give the donation, after that, if the approval of the trust or the institution is withdrawn, your donation will not be denied. Don't worry about it. You will get the deduction. Today, I gave the donation, so I took the deduction. After a few months, the government is withdrawing the approval of that institution because they are engaged in some illegal activities. Your deduction will not be withdrawn. Don't worry. You will get the deduction. Don't worry about it. Okay. Next. I have bought an asset. Listen carefully. Now, this is a very critical point. Not much important for exam. This one is not much important, but it is very critical. Suppose I bought an asset of 1 crore rupees in scientific research department and I took deduction of 100% on that. It means I bought a plant and machinery of 1 crore and I took deduction of 1 crore because I got 100% deduction under section 35(1)(4). So what shall I do after a few years? Now, after a few years, I can do 2 things. I can sell from there itself. If I sell from there itself, it can be called as it is sold without using for business and profession. Okay. It is sold without using for business and profession. And if it is sold without using for business and profession, I bought it for how much? 100 crores. And suppose I am selling it for 120 crores from that department itself. Then in that case, I have to bear the brunt of deemed income. How much deemed income? Sale proceeds, forget about this. This will be knocked off. Sale proceeds compared with deduction allowed. Suppose deduction allowed was 100 crores or 1 crore and sale proceed is 1.2 crore and therefore whichever is lower will come to 1 crore. I will claim 1 crore as my deemed income. I will not claim. In fact, I have to offer that 1 crore as deemed income. And then my capital gains will be computed as per section 48, which is other than block concept because this asset is not a part of block. Now, one more option which I have bought a plant and machinery of 1 crore, took deduction under section 35(1)(4) few years back, and after a few years, I want to shift that plant and machinery to my business. So, if I want to shift that plant and machinery to my business, then that particular plant and machinery will form block of asset of the other plant and machinery. So, what will be the actual cost of that? And that is defined in explanation 1 to 43(1), and that actual cost of that asset will be nil. So, if a machinery which was earlier a part of scientific research department and later on if you shift that to a business department, it has to be forming part of some block, na? Either plant and machinery block or furniture block or building block. You have to put it in some block, and then that case your block should have some kind of value to that, and the value given to that is 0. So, the government said that what will enter the block is the quantity, but the value will be 0 because you have already claimed 100% deduction on that. We cannot give you depreciation on that asset once again. And later on when you will sell that asset, you will be liable for what? Capital gains as per section 50, which is as per block method. So here you are selling without introducing into business. So here you will compute capital gains as per normal calculation, but here you will compute capital gains as per what? Section 50, that is the block of asset concept. I hope it is clear to all of you. Now, new compliances have been laid down by the government of India. That is when you give donation to the donee. I am a donor, other party is donee. Who is donee? Donee is the institution which is registered under section 35(1)(2), 1(3), 2AA, 1(2)A. These are the institutions who are donees. These are the institutions who are donees. So now the government has put certain restrictions on these donees. The donee has to do 2 things. First, the donee has to give certificate to the donor. Secondly, the donee has to file a statement to the government of India that who all have given donation to him. So these 2 things the donee has to do within the prescribed time. If the donee doesn't do these 2 things, then the donee will be liable to a fee of 200 rupees per day and will also be liable to a penalty of 10,000 to 1 lakh rupees. So these 2 work has to be done by the donee. Which donees? Who are covered under this section and also who are covered under ATG. Even ATG donees have to do these things. These are the compliances which the government has put now on the Scientific Research Association and also to the institutions which are registered under 80G. So this is what section 35 is all about. Now let us go ahead with the next one, which is a small one, that is amortization of telecom license fees, which is covered under section 35ABB, and amortization of spectrum fees paid, which is covered in section 35ABA. Both the sections are having same kind of deduction, but the nature of license is different. Spectrum license is a different thing and telecom license is a different thing. Okay, but the nature of license is different, but the deduction is same only. If you incur the expenditure, the entire deduction is allowed on actual payment basis. If you do not make the payment, it is not allowed as deduction. And the entire deduction, because the amount is too huge, it is a very big amount. Therefore, the deduction would be allowed over the life of the license and not in 1 year. So in how much life it will be allowed? It will be allowed over the unexpired life of the license. Okay. So if you have made the payment of the license before the commencement of the business, then the deduction will start from the year of commencement over the life of the license. And if you made the payment after the commencement of the business, then the life will start from the year in which you have made the payment. Okay. So suppose the business is starting today. So if you have made the payment before the commencement, then it will start from today over the life of the license. Suppose the business has already started and you have made the payment after 2, 3 years, 5 years, 10 years. Then the deduction will be allowed from the year in which you made the payment again over the life of the license. Okay. Once you take the deduction under these two sections, you will not get any deduction under section 32 in the form of depreciation. You cannot say that please allow me depreciation on intangible asset because license is also intangible asset. The deduction of depreciation is denied over here. It is not allowed later on. Later on, if you transfer the asset, transfer the intangible asset, transfer the license, then you have to bear the brunt of what? Deemed income. Whatever deduction was claimed earlier will be considered as deemed income, and you will also be chargeable with what? Capital gains implications over here. Okay. Now coming to the next one, that is an important one, that is 35D, preliminary expenses. How will you get the deduction of preliminary expenses? Before we see how will we get the deduction of preliminary expenses, first of all, we need to understand to whom this deduction is available. This deduction is available only to Indian companies and companies other than companies. If you are not a company, then you should be resident. It means this deduction is only available to residents. It is not available to the non-resident. The assessee has to be either Indian company if it is a company. If it is not a company, then the assessee has to be a resident. Okay. Then the expenditure should be incurred on specified purpose. What do I mean by specified purpose? I'll talk about that specified purpose in a while, which all things can come in that specified purpose. Now, timing of expenditure. When should the expenditure be incurred? The expenditure can be incurred before commencement and even after commencement. But after commencement, there are certain conditions. What condition? The expenditure, if it is incurred after commencement, then it should be incurred only for the purpose of extension or expansion of the business or for setting up of a new unit. So if the business expenditure is incurred, if the amortization expense is incurred for the purpose of post-commencement period, if it is pre-commencement, then it is allowed. There is no restriction. But if it is for post-commencement period, then it should be for either extension or for setting up of a new unit. Now, how much deduction will be allowed to the assessee? The deduction which is allowed to the assessee will be the actual expenditure incurred by the assessee, point number 2, compared with point number 1. What is point number 1? It is 5% of cost of project compared with 5% of capital employed, whichever is higher. So the point number 1, you have to compare two things, whichever is higher, then you have to compare with point number 2, whichever is lower, and then that will be allowed as deduction. So point number 2 is very straightforward. Your actual preliminary expense is point number 2. Point number 1 will have 2 points within that itself, and in that you have to select whichever is higher. So 5% of cost of project means what? Cost of project means cost of all the fixed assets which is employed by the company. Cost of project means cost of fixed asset. So you have to take the total of fixed asset. You have to take 5% of that total. Okay. And then on which date I am supposed to take that? You have to take which date I have to consider the total cost of project. You have to consider the total cost of project on the last day of the previous year in which the business commences. You have to consider that on the last day of the previous year in which the business commences. Okay. Similarly, 5% of capital employed. What all things will capital employed include? Capital employed will include share capital, debenture, as well as long-term borrowing. On which date I am supposed to take that? You have to take that on the 31st of March of the year in which you have commenced the business. So both the places you have to take the last day of the financial year in which you have commenced the business or the last day of the financial year in which you have made an expansion or extension or you have set up a new unit, as the case may be. Okay. Now, in this, there is one issue which went to Supreme Court in the case of Berger Paints Limited, whereby it was held that share capital will not include share premium. It will be merely share capital and it will not include share premium. You can see over here. Okay. Now, if the assessee is an individual HUF firm, AOP, BOI, if it is a company, then this is a correct formula. But if it is not a company, then in that case, you have to ignore capital employed point. Okay. You have to compare 5% of cost of project with actual expenditure, and whichever is lower will be allowed as deduction as it is written over here. Can you see this? Now, what are the specified expenses which can cover over here? There are a lot of specified expenses, but Just the government has said that most of the expenses which you are incurring over here has to be approved by a authority. If it is approved by authority, then it is allowed as deduction. If it is not approved by authority, it is not allowed as deduction. It is as simple as that. There is nothing great apart from this said by the government of India under this particular point. Okay. Now let us go ahead with the next deduction, which is a big one, 3580, which is only available to deduction of certain capital expenditure. This section is not for revenue expense. It is only for capital expenditure. The nature of business covered over here is the 14 business, which you can see over here one by one. 11 business over here and 3 business over here. Let us go through all of them. The first business, the associate should be engaged in cold chain facility. Second, warehousing for agriculture product, hospital of at least 100 bed, housing project for affordable housing scheme, and then housing project for slum redevelopment, production of fertilizer, cross country natural gas or crude oil or petroleum pipeline, hotel of at least 2 stars, inland container depot, inland container freight station, beekeeping, production of honey and beeswax, warehousing facility for sugar, then laying and operating a slurry pipeline for transportation of iron ore and not any other mineral. Then comes the semiconductor wafer fabrication manufacturing unit, and then comes infrastructure facility, setting up and operating an infrastructure facility in India. Nobody. Infrastructure would include road, highway project, housing projects, water supply projects, sanitation project, irrigation projects, sewerage project, port, airport, inland waterway, inland port, navigational channel, so on and so forth. Now, you are not supposed to buy hard this, the way I am trying to tell you. You should be aware that these are the businesses which are covered in 3580. Okay. You are not supposed to buy hard. No need to buy hard. Now, when the deduction should be incurred. Now, there are 2 case laws over here, which we need to address one by one. First one. It was held by Supreme Court in the case of CIT versus Concor Limited that inland container depot can be treated as infrastructure facility. So, in infrastructure facility, you can also take inland container depot. This is what a very small clarification given by Supreme Court. Similarly, it was held by a court whereby, now this is an important one. This one is important. One of the important business out of the 14 business is hotel. And hotel has to be of at least 2 star or above category. So if I make an application, say today, say in April 2022, and if I get the registration by the government that yes, you are approved for 2-star hotel in the next year, say in 2023, I will get deduction from 23 or 22. This is what the court has clarified. The court has clarified that if you make the application today and after 1 year, if the government approves your application that you are an eligible 2-star hotel, you will get the deduction from today itself. That is from the year in which you make the application. This is an important development by the government. Now, out of the 14 businesses which we have seen, the 6th business, that is the cross-country pipeline one, and the 14th business, that is the infrastructure business. These 2 businesses are available only to Indian companies or consortium of Indian companies. Consortium means a joint venture of Indian companies. Apart from these 2 businesses, rest of the 12 businesses are available to all kind of associates. I hope it is clear to all of you. Out of 14 business, these 2 businesses are specifically dedicated to Indian companies or consortium of Indian companies. Rest of the businesses are available to all kind of associates. Okay. Now, which kind of deduction is allowed over here? As I've told you at the beginning of this section, only a capital expenditure is allowed under this section, and the capital expenditure has to be incurred when? It can be incurred in pre-commencement, in post-commencement, it doesn't matter. If it is incurred in pre-commencement period, there is no time limit also like scientific research, there is a time limit of 3 years. There is no time limit over here. In pre-commencement, whatever capital expenditure you have incurred, you have to do just one thing, that you have to capitalize in the books of account on the date of commencement of the business. So in the last 4 years, you have incurred a lot of capital expenditure. You have to capitalize in the books of accounts on the date of commencement. That's it. You will get the full deduction 100% in first year itself. What about post-commencement? Even in post-commencement, you will get the deduction. Your business is running on. It's going on. You are incurring some expenditure of capital nature for that particular business, which is a specified business. You will get the deduction. Don't worry about it. But you will not get deduction of 3 expenditure. One is land, one is goodwill, and one is financial instrument. Neither in pre nor in post. These 3 expenditures are not allowed. Under this section, and it's a very important part, there are a lot of questions which ICI has asked about this particular point. So land is not allowed, goodwill is not allowed, financial instrument is not allowed. Plus, if you are purchasing an asset under this section to claim a capital expenditure, and you are making a payment for that asset to a person in a day, in excess of 10,000 rupees, then you have to make the payment by account pay check, account pay draft, ACS, or such other electronic mode as it is allowed. It means if you make the payment by cash or bearer check or normal cross check, it shall be disallowed. It will not be allowed as deduction to you. Just like depreciation also. For depreciation also, you have to purchase the asset by account pay check, bank draft, ECS, such other electronic mode. Okay. Next, there are certain conditions. This is a big section. There are a lot of points in this particular section. I'll try to cover each and every minute details also in this revision video. I will make sure that I will not miss out even the smallest of the point, but because that is the catch in CA final. Those smallest of the points become the biggest of the point in the exam. And that is my duty to address you smallest of the point in the revision videos also. Not in that depth, but just to give you an overview of each and everything in the class. Okay. So there are some conditions now which we have to keep in mind to claim deduction under 3580. The first one, your business should not be formed by splitting up or reconstruction of an already existing business. It means your business has to be a new business. It cannot be second-hand business. New business. Then only this deduction is available. Secondly, in your business also there should not be any second-hand plant and machinery. Second-hand plant and machinery not allowed. But there are two exceptions where second-hand plant and machinery will be accepted. If your second-hand plant and machinery is 20% of total machinery, then it is allowed. Second, if your second-hand plant and machinery is an imported second-hand plant and machinery, then it is allowed. But in that case, the depreciation should not have been claimed earlier. Then only it is considered as an imported second-hand plant and machinery, which is allowed as deduction. If an imported second-hand plant and machinery, which you are importing, which is second-hand, and it has already claimed depreciation under Income Tax Act, then it is not allowed. Okay. Further, once you claim deduction under this section, you will not get deduction of the same amount under any deduction under Chapter 6A or 10AA or Section 32. Neither normal depreciation nor additional depreciation, nothing would be allowed. Once a deduction, say, of a hotel, hospital, cross-country pipeline, whatever it is, you have claimed over here, you cannot claim the deduction of that particular profit again under what? Chapter 6A or 10AA or 32. In Chapter 6A, there are certain profiting deductions. You cannot claim over there. You cannot get dual benefits over here. Now, special benefits to hotel industry. Now, what is written for hotel industry? Do you know that? In the BEAR Act, in the income tax law, what is written is that you will get the deduction if the assessee is engaged in building an hotel and then operating the hotel. It means the assessee has to build the hotel first and then also operate the hotel, then only the assessee would get the deduction. But hotel industry runs on a concept of franchise, whereby the owner will build the hotel and will give the operations to certain other person for the purpose of what? Running that hotel. So in that case, the assessee was not getting the deduction because the assessee was building the hotel, but it was not operating the hotel. Operations were given to the franchise. So in that case, the government understood the nature of business, the government understood the problem of this particular industry and said that in Finance Act 2012, that if an assessee is engaged in the business of building an hotel, it will be allowed deduction even if the operations are transferred to some other person. Check over here. Even if you transfer the operation, but you build the hotel and own the hotel, you will get the deduction. Don't worry about it. Now, there are a lot of deductions which are available over here. Section 3580, capital expenditure, 100% deduction you will get. Of all assets excluding land, building, land, goodwill and financial instrument. Rest all deductions you will get 100% capital expenditure. So there are bound to be losses under income tax law. So what will be the treatment of that loss? That losses will be carried forward and set off as per section 73A, and it can be carried forward and set off against any other only specified business, not against other business. And it can be carried forward for infinity number of years. There is no time limit in carrying forward. But there is a restriction in setting off. Against which income you can set up? Only against any other specified business, not against other businesses which are not specified under 3580. And last but not least, deemed income. If an asset on which you have claimed deduction under 3580, if it is demolished, destroyed, discarded, or you have sold, keep these four words in your mind. If it is demolished, destroyed, discarded, and you are sold or transferred, then whatever is the sale price will be your deemed income. There is no time limit. Even if you do it by 1 year, after 1 year, or if you do it after 2 years, or if you do it after 20 years, you have to pay the sale price as your deemed income. And you have to pay tax as per section 20, and it will be income. You have to pay tax on that. This is the first thing. What? Destroyed, discarded, demolished, and transferred. What about if I purchase an asset, say building of 100 crore. I claim deduction of 100 crore. And I started using that building for non-specified business. Then what will happen? Government has put a lock-in of 8 years for that. If you have claimed that deduction to 3580 and if you use it for non-specified purpose for a period of 8 years, beginning from the previous year in which the asset was acquired, then there will be deemed income. How much deemed income? The deduction allowed earlier, that is 100 crore, minus depreciation, that is normal additional depreciation you have to reduce, and that much amount will be considered as what your deemed income. Suppose if you have purchased a building 2 years back, so you have claimed a deduction of 100 crore 2 years back. Now after 2 years, in the third year, you are using that building for non-specified purpose, then you have to bear the brunt of deemed income under section 3580 subsection 7A 7B. How much? 100 crore deduction out minus 2 years depreciation. First year's depreciation will be 10 rupees. Second year's depreciation will be 9 rupees because of WDB. And therefore the amount which will be left will be 81 rupees. I have said you, I have given you examples on this in class. So that 81 will become deemed income. Now later on, that asset, if you use for non-specified purpose, then will I get the depreciation on that non-specified purpose? The answer is yes. As per explanation 13 to section 43(1), you will get later on this amount, which will be deemed income over here now. That amount will become what? The actual cost to the assessee, and assessee can claim depreciation because the assessee has bear a tax on this 81 rupees. So now the assessee is free to use that money anywhere. And therefore the assessee, if using that particular asset for other business, the assessee would be getting depreciation on that particular amount. That is 81 crore or whatever amount it is. 81 rupees will be added to the block of asset and assessee can claim depreciation on that amount. I hope it is clear to all of you. This is what this great deduction is all about. So now let us go ahead with the next one, that is section 35E, which talks about taxation of mining of coal, limestone, iron ore, etc. If an assessee is engaged in extraction of mines, etc., to say extract coal, iron ore, or lignite or other kind of natural resources, then this deduction is available for that. Now this deduction, just like 35D, is only available to Indian companies, not to foreign companies. And if you are not a company, then it is available to only residents. And what kind of expenditures you will incur? You will incur expenditure in the nature of prospecting of minerals. You are trying to find out minerals, and for that you are digging the mines, etc. And for that, lot of expenditures are incurred. That expenditure is allowed as deduction over here. Or you are incurring expenditure for development of mine or other natural deposits. Now, how much deduction will be allowed to you? Your deduction allowed will be the amount incurred by you for above purpose minus if any amount is met by any government. Okay. So if the government is meeting some amount, then that amount in the form of subsidy, etc., then that much will be reduced from what? From your amount incurred. Okay. Now, what is the timing? When the expenditure should have been incurred? The expenditure should have been incurred like in scientific research. When the expenditure should have been incurred? The expenditure should have been incurred in case of scientific research in the last 3 years from the date of commencement. Similarly, here, when the expenditure should have been incurred? The expenditure should be incurred in the year in which you start your commercial production from that mine which you are digging, and the last 4 years. So if you have started to earn some money out of that mine in current year, then current year and last 4 years will be your qualifying period. So in that period, whatever expenditure is incurred minus whatever amount is met by government will be allowed as deduction to you. But how? I'll be talking about that. It is amortized over years. Then certain expenditures are not allowed over here. First, if you incur any capital expenditure in the nature of acquiring the minerals or rights, you are acquiring the entire site, then it is not allowed. You are acquiring the entire deposit, then that is a capital expenditure, not allowed as deduction over here. Or you are buying a building, plant, machinery, furniture for which depreciation is already admissible under section 32, then that particular thing is not allowed as deduction under this particular section. Moral of the story, here what is written, most of the capital expenditures are excluded from the deduction over here. Okay, now listen carefully. Whatever expenditure you have incurred in the current year of the commercial production and the last 4 years will be qualifying amount minus amount met by the government will be the qualifying amount. Suppose you have incurred 10 lakhs in current year and last 4 years to extract that mine. And now that mine is ready, you are earning some money, you are having a commercial production out of that mine. So 10 lakhs you have incurred minus 50,000, say government has contributed. So 10 lakh minus 50,000, 9 lakh 50,000 will be qualifying amount. So how much deduction you will get in the first year? You will get 1/10 of that deduction in the next 10 years. So 1/10 of 9 lakh 50 will come to 95,000. Compare with the income. Income of what? Income of all mines. This mine as well as if you have any other mine already in your business. You have to compare this amount of 95,000 with this mine as well as any other mine which is in your name. Compare with that, whichever is lower. And suppose this is 95,000 and suppose the second point is coming to 50,000. Then 45,000 deficit you can add to the next year's income. And you can take the deduction in the next year. So in the next year, if there is a deficit in the first year, because point number 1 is 95, point number 2 is 50. So answer will be 50. You will be allowed deduction of 50,000 in the current year. So 45,000 is the balance. What has to be done? That is unabsorbed. You can add to the next year's expenditure and you can say the next year's expenditure is 95 plus 45. So next year's expenditure will be 1,40,000 and you can take the deduction of 1,40,000 next year. Okay. So this is how it will run. Okay. And it will be carried forward for how many years? It will be carried forward for the next 9 years. Current year and the next 9 years. Okay. I hope it is clear to all of you. Let us move on to the next one. This was not much important for exam. ICI has not asked this particular deduction. I don't think so. I have not seen a single question on this in the last 10 attempts. Now, let us move on to the next one. This is an important one and a very, very critical one. 36(1)(7), a provision for bad debts for banks and NBFC. And for that purpose, I have told you earlier under section 36, subsection 1, clause 7, you do not get the deduction of bad debts. Provision for bad debts. Sorry. You get deduction of only actual bad debts over there, not provision for bad debts. So for provision for bad debts, I have told you that you will be getting deduction only if you are a bank or financial institution, etc. So here the government has categorized all the banks into two categories: scheduled bank, non-scheduled bank, cooperative bank on one hand, and state financial institution, public financial institution, foreign banks, NBFC on another hand. So examiner will tell you which bank is scheduled bank, which bank is non-scheduled bank, which bank is cooperative bank, which bank is public financial institution, which is NBFC, which is the foreign bank. They will give in the question. So if you are a scheduled bank, etc., then you will get two deduction: 8.5% of GTI 8.5% plus 10% of aggregate average advance from rural branches, from not all branches, only from rural branches. So you will get 8.5% of GTI as well as 10% of the rural branches aggregate average advances. Both the deduction you will get. But for other banks, unfortunately, only one deduction, that too on the lower side, that is 5% of GTI. That's it. They will not get this deduction. Okay. Now, will I get the deduction of bad debts also? Yes, you will get deduction of bad debts if your bad debts exceeds your provision for bad debts. Suppose your provision for bad debts as per this particular provision is coming to 100 and your actual bad debts is 150. Then you will get 50 rupees as bad debts. Don't worry about it. But if your accumulated provision for bad debts has to be seen, suppose last year's opening balance 100, this year's provision for bad debts another 100. So your cumulative balance is 200. Compare with actual. If actual is 250, you will get 250 rupees reduction as provision for bad debts. Don't worry about it. Okay. Next, transfer to special reserve. It is available to which assessee? Again, this is sector-wise deduction. 36 subsection 1 clause 8. Not available to all assessees. Sector-wise deduction. Very specific sector. Which sector? It is available to certain banks, public financial institution engaged in providing long-term finance. Long-term means at least for 5 years or more. If a public financial institution or banks provide long-term finance for 4 purpose: industrial purpose, agriculture purpose, housing purpose, and infrastructure purpose. If they provide long-term finance for these 4 purpose, they will get deduction of the lower of the 3. How much? Amount transferred to special reserve during the previous year. Compare with 20% of PGBP from this business, not all business, only 20% of profits of this business, and compare with 200% of paid up capital plus general reserve as on the last day minus special reserve account balance on the first day. Whichever is lower will be allowed as deduction. And once that deduction is claimed by the assessee has to just transfer that amount to special reserve account. And the assessee will get the deduction, subject to least of the 3. And once the assessee has transferred that amount, the assessee cannot withdraw that amount and credit that to P&L. If the assessee withdraw that amount and credit that to P&L, then that will be deemed income under section 41(4)(a). 41(4)(a) will become deemed income at the same time. Be very careful about it. Okay. So this is what this section is all about. Important one. Sometimes it comes in exam. Not very important, but slightly important. Next, there are some small deductions which I am addressing now one by one that will complete all sector-wise deductions. 35 CCA. If you make payment to any association or institution for rural development, suppose there is an organization, there is a trust who is engaged in rural development, you are making a payment to that particular association, you will get deduction. Okay. Second, if you are incurring in 35DD, if you are incurring an amalgamation or demerger expenses, you will get deduction, but this deduction is only available to Indian companies, not to others. That too, it will be amortized over a period of 5 years. It will not be allowed in one single shot. So, sir, which all section there is an amortization? For that, there is an interlinking of PGBP chapter which is coming later, which I have said about just some time before in this lecture itself. Right? 35DDA, amortization of VRS expenditure, voluntary retirement expense. It will be also allowed in 5 equal installments, not in one single shot. And in the bracket also I have written which all expenditures are allowed in 5 equal installments. That is, we have learned capital expenditure of family planning. We have learned preliminary expenses on previous pages. We have learned just now amalgamation of demerger expenses in the above line. And now VRS expenditure. These are the 4 expenditures where there is a 1/5 deduction. Okay. Then if you are incurring an expenditure for agriculture extension project, you will get deduction. Agriculture extension project means you are doing some work for the welfare of the agriculture in India. You are giving some donation to the, you are giving some money to the, to buy tractors to the farmers, etc. This is known as agriculture extension project. You are just extending your hand towards agriculture in India. And last but not least, the last deduction 35 CCD, it is only available to Indian companies, to companies, not Indian companies, all kind of companies, and here land and building is not covered. And what kind of deduction is this? All companies are covered. Land and building not allowed in this deduction. And what kind of deduction is this all about? It is about skill development. You are incurring an expenditure on training, etc. of the employees, which is giving them skill, in India to work in the company, and therefore that will be allowed as deduction under income tax law. And last but not least, section 42. There is nothing written in this section, not much important also. It is giving deduction to those businesses which are engaged in prospecting, extraction, production of mineral oil, and who have entered into an agreement with central government to do that. So there has to be an involvement of central government. So central government will have an involvement in that, and there will be an agreement between assessee and central government, and that agreement will decide all the things. Even the income tax expenditures will be decided by that agreement, and according to that agreement, you will be getting the deduction. This is what it is given in this section. Apart from this section is not important for exam. They have never ever asked this. Just go through it, and then we'll move on to the next chapter, and that is general deduction. So now let us move ahead towards our last deduction, that is general deduction under section 37(1). You have to go over here. But before that, you need to also understand one more thing, and that is, what is the implication of deduction of losses under income tax law? Now listen carefully. Losses can be of 2 types. One is trading losses, another is capital losses. So there are no specific sections for both of them under the entire income tax law. Neither income tax law talks about specifically about trading losses, nor income tax law talks about capital losses. So you have to keep one thing in mind. For that, we need to go to Supreme Court judgment. So Supreme Court has held that trading losses which are incidental to the business, which are necessary for business, will be allowed as deduction, but capital losses will not be allowed. So this is a thumb rule now for all of us. The trading losses which are incidental to the business are allowed as deduction, but capital losses are not allowed. Trading losses examples: loss of stock by theft, loss of stock by fire, embezzlement by employee, cash lost, cash embezzled by employee. These are some of the example of trading losses which will be allowed as deduction, to arrive at the real profits of the assessee. This is not said by me. This is said by Supreme Court in 1958 in the case of Badri Das Daga versus CIT, and in 1959 in the case of Calcutta Company Limited. It was held that trading losses will be allowed as deduction. This is the first thing which you have to keep in mind before starting with this particular topic, that is general deduction. Now let us start with general deduction 37.1. In general deduction 37.1, you have to fulfill 4 conditions. 3 negative conditions, 1 positive condition. 3 negative conditions are: the expenditure should not be covered in 30 to 36. The expenditure should not be personal. The expenditure should not be capital, and should be incurred wholly and exclusively for the purpose of business and profession. 3 negative condition, 1 positive condition, and you will get the deduction under 37.1. But it is not that easy to interpret this particular section. There are more than 5,000 Supreme Court, High Court, and ITAT judgments on this particular case, on this particular section. More than 5,000 means you need to understand the nature of litigation, the coverage of litigation over in this section, how litigative this section is all about. Now let us go ahead. Below this section there is an explanation which talks about that if you incur an expenditure, explanation 1 to section 37.1, which talks about if you incur an expenditure which is an offense or which is prohibited by law, it is not allowed as deduction. Not allowed, not allowed, not allowed. An expenditure incurred for an offense or which is prohibited by law is not allowed as deduction. Second explanation, explanation 2 section 37.1, which says that if you incur an expenditure which is considered as CSR, corporate social responsibility expenditure, as per section 135 of Companies Act 2013, it shall not be allowed as deduction under income tax law. Let me tell you very, very clearly. And who is liable for CSR? That you have learned in 135 of Companies Act, whose turnover is more than 1,000 crore or profit is more than 5 crore or net worth is more than 500 crore, as the case may be. That company is liable for CSR, 2% of the average profit of the last 3 years. So Government of India is very clear about income tax law. In income tax law, you will not get the deduction of CSR. But yes, if that CSR, which is considered as CSR in section 135 of Companies Act 2013, and that is covered in some other section of income tax law like ATG, like 3512, 3513, then the government will not disallow ATG or 3512 or 3513. That is allowed. Moral of the story, if the CSR is not covered in some other deductions of income tax law and you are asking for that deduction of CSR under 37.1, then that 37.1 will be disallowed for you. Okay, keep this thing in mind. Let us talk about penalties. What is the treatment of penalty? Penalties can be of 2 types. If a penalty is of penal nature, it means for breaking a law, then it is disallowed. But if the penalty is of a compensatory nature, that is in the nature of a compensation. Suppose if I have not done your work in business, suppose I have taken a contract from you and I have not completed the contract on time, so I have to make a payment to you of a penalty. So that is a contractual penalty. That is not a penal penalty. That is a compensatory penalty, and that is allowed as deduction. Because what is disallowed under income tax law is something which is for breaking a law, not for breaking a commitment. So if I am breaking your commitment and I am not doing your work on time, I have to make a payment to you in the form of a compensation, that is allowed as deduction. Next, whether the penalty under income tax law will be allowed, not allowed. Whether interest under income tax law will be allowed, not allowed. Whether the interest under GST will be allowed, yes, it is allowed. Whether the penalty under GST will be allowed, penalty under GST will not be allowed. Therefore, interest will not be allowed under income tax law, but in GST it is allowed. Penalty will not be allowed in both the law because that is for breaking both the laws. Okay. Whether secret commission will be allowed as deduction. Secret commission. What is secret commission first of all? Secret commission is under the table commission which you give to some person to take some contract. You give that particular person a commission under the table so that the contract is in your name. That is not allowed because that is bad in law. That is illegal. That is not allowed. Okay. Next, if the pharma companies give some freebies to what? To doctors, to medical associations, whether that will be allowed as deduction, it shall not be allowed as deduction. As per CBDT Circular 5/2012, if a pharma company gives freebies to doctors that recommend my medicines to the patients, give freebies to the medical association that recommend my medicines to the what? To the doctors. Therefore, that expenditure is not allowed as deduction as per Circular number 5/2012, which was issued in 2012 by CBDT. Now, there are people who have challenged this circular later on. I'll be coming to that particular judgment in a while. Whether the deduction of key man insurance policy is allowed as deduction. If I make a payment for a key man insurance policy, if I make a premium for key man insurance policy, whether that premium will be allowed as deduction, the answer is yes. The question is not about this. The question is, if a partnership firm make a payment of key man insurance policy premium for the partner, whether that will be allowed as deduction. CBDT has clarified that if the partner is important for the business, then it is allowed. And if that partner is very important to safeguard the business against the disruption of the business, then if for that partner is such an important partner that the entire business will be disrupted if that partner is not there, and if you are taking a key man insurance policy for that partner, then even the partnership firm will be allowed a deduction. Don't worry. Next, whether losses of illegal business will be allowed as deduction. Unfortunately, the Supreme Court held that answer is yes. This Dr. T.A. Qureshi was doing some business of illegal narcotics and he got caught. When he got caught, he was having a stock of some 5 lakh rupees with him. So government confiscated that 5 lakh rupees stock. So that 5 lakh rupees stock, when the government confiscated, the assessee started saying that this is my stock in trade ka loss. And because it is a trading loss, it shall be incidental to the business. My business was of illegal nature. It shall be allowed as deduction, and Supreme Court unfortunately allowed it. And even today it is allowed. So you keep this thing in your mind, because this is a very important adjustment in exam. That losses of illegal businesses are allowed as deduction. Illegal losses are allowed because there is no specific explanation. What is covered in explanation 1 is only expenditure. Illegal expenditure is not allowed as deduction. Illegal losses is not allowed as deduction. There is nothing like that under the income tax law. Therefore, as per this Supreme Court judgment of T.A. Qureshi, illegal losses will be allowed as deduction to the assessee. Be very careful. Okay. Next is whether the expenditure of advertisement is allowed as deduction. Answer is yes. But if you make the expenditure of advertisement in a brochure, in a political party, then it is not allowed. But unfortunately, it is not allowed under PGBP. But it is allowed as deduction. You can show that as a donation, and you can take deduction under 80 GGB and 80 GGC. So moral of the story, what will be the treatment? You disallow under PGBP because it is in a brochure of a political party. But you can take that as a deduction, as a donation under 80 GGB or GGC. It is allowed as deduction. Okay. Next is a clarification of BOT project. What is BOT project? It's a build, operate and transfer project. The full form is build, operate, transfer project. Now what is this? Here what happens? The government has land and you are a constructor, and government will give you land. You'll make bridges, you'll make roads, and will collect toll for 15 years, 20 years. And after the project is completed, you will transfer back the land to the government. You don't own the land. The land is of the government. The government owns the land. Government gives you the land, the possession of the land. You build the project. So say government has given land from Mumbai to Delhi to make a highway project. And you have made a project over there, and you have incurred an expenditure of say 10,000 crore on that. So how to take the deduction of that 10,000 crore? So this is what BOT project tells you. After the period, after the maturity comes, say after 15 years, 20 years, then you have to give that particular highway to the government, because the land does not belong to you, it belongs to the government of India. So how will you get the deduction? In that case, the deduction will be allowed as follows. Listen carefully. Whatever expenditure you have incurred, divided by the life of that particular project. For how many years that project is with you? You have to divide that, and whatever amount will come, that will be apportioned over the life of the project, and you'll be getting deduction every year according to that. Okay. Now, any deduction if you have already claimed in some other form in other expenditure, it will not be allowed again over here. That's it. There is nothing great in this, and it's not much important also for exam. Now, there are certain small Supreme Court and High Court judgments. Let me tell you one by one all of them. First, Kerala Road Lines Supreme Court judgment, an important one. It has come in the exam also once or twice. What has happened in this case? The assessee has bought a building. After buying that building, the assessee has demolished that building, and whatever scrap has come, assessee has offered that scrap as PGBP income. Now, as against that, assessee also has to make the payment to the other person, because he has bought the building from some person. So assessee has to make the payment for that building. So assessee made the payment for that building in delay. So assessee has to make some interest payment for that, because the assessee is making the payment in delay, not on time. So that interest, assessee started taking deduction against the scrap of the building. Will that be allowed as deduction? And the answer is yes. Because the scrap is related to building, and that scrap is offered as PGBP income, and this interest income is also, this interest expense is also related to building. This expenditure can be allowed as deduction against what? Against the scrap income. There is nothing wrong in that. Okay. Next one, Confederation of India Pharmaceutical Industry. Here the pharma companies have made a petition to the High Court of Himachal Pradesh, whereby they have said that this circular is not correct. Which circular? This, which says that any freebies given to what doctors or medical association will be disallowed. So the High Court has held that. High Court has given a very contradictory view. On one hand, the High Court says that the government is correct. On the other hand, the High Court says that the assessee is correct. You can see over here. On one hand, the government says that such expenditure has to be disallowed because this is in violation of Medical Council Act, Medical Council regulation. On the other hand, the High Court says that if it is not violating any regulations of Medical Council, then it shall be allowed also. So the High Court is not clear over here in this particular judgment whether the expenditure should be allowed or not. The High Court is putting back the responsibility on the government of India and on the assessee, that they will prove. They have to prove that whether the expenditure which is incurred, is it violating Medical Council regulation? If it is violating, then disallow. If it is not violating, then allow. It is as simple as that. Okay. Next one. Suppose I am a doctor and there is a diagnostic center over here. That diagnostic center is giving me commission. Why? So that I can refer my patients that go to this diagnostic center. Will that be allowed as deduction? The answer is no. It is bad in public policy. It is. The referral scheme are not allowed over here. These kind of referral schemes under the medical sector will not be accepted by the government of India, and therefore this is not allowed. This is disallowed. So if a diagnostic center is referring, if a doctor is referring patients to diagnostic center and that diagnostic center is giving you commission to the doctor, that will be disallowed under income tax law. Next, this is company Dinesh Mills Limited, Gujarat High Court, whereby what has happened in this case? In this case, there was one accountant, there was one clerk who was misappropriating cash every year to the extent of lakhs of rupees. So in first year, he has misappropriated approximately 4.5 lakhs, second year approximately 5 lakh, third year approximately 3,80,000. And in the fourth year, he got caught. Pakda gaya. He got caught. So now what will happen? Will the company get the money? Company is not getting the money. So will the company get the deduction? The answer is yes. Company will get the deduction. Don't worry. So in the first 3 years, the clerk has misappropriated huge amount of cash, 10 to 12 lakhs cash. In the fourth year, he got caught. When the company asked him where is the money, he said that I have lost the money. I have used the money. I don't have money. So this is the loss to the company, and it will be allowed as deduction to the company. Don't worry. Next one is Motilal Khemchand. Khemchand Motilal Jain Tobacco Product Limited. It is a very funny case law whereby the whole-time directors got kidnapped. So the company filed a police complaint, and police was unsuccessful. So the company forcefully had to give the ransom to release the whole-time director. So will that ransom be allowed as deduction? As per the Madhya Pradesh High Court, yes, it is allowed. Because the police was unsuccessful. What the assessee will do? Let him be with them, with the dacoits. So that is not possible. Therefore, because the police was unsuccessful, it was allowed as deduction. Check. Next, Shanti Bhushan. Again, this is a very funny case law. The assessee has done his heart surgery. Assessee being a lawyer, done his heart surgery, heart transplant. Will that be allowed as deduction? The Delhi High Court has held that this cannot be allowed as deduction under 31, nor it can be allowed as deduction under 37.1. It cannot be allowed as deduction under either of the sections. Okay. Next, Millennia Developers, Karnataka High Court. What has happened? The Karnataka Municipal Corporation Act has allowed assessee. Assessee is a builder who builds building. He is a developer. So the Karnataka Municipal Corporation Act has allowed the assessee, has given the permission to make a building up to 7 floors. But the assessee unfortunately made the building of 8th floor, 1 floor extra. So that 1 floor extra, he has done an offense. For that, he has to make a payment of fee, compounding fee. So assessee makes a payment of compounding fee. That is in the form of penalty. Whether that penalty will be allowed as deduction, the court has held that no. Merely because it is treated as compounding fee, that does not mean that the assessee has done something correct. The assessee has violated the law of Karnataka Municipal Corporation Act, and therefore violation of law and any expenditure incurred for violating a law will not be allowed as deduction in light of explanation 1 to 37.1. Okay. Next one, Triveni Engineering. Here assessee has made 2 mistakes. First mistake, he has given an advance to employee and the employee ran away. Whether that advance to employee given to employee and the employee being running away, whether that will be allowed as deduction, the answer is yes, because it's a revenue loss. Second, he has given a security deposit to the landlord so that the landlord can give him a property on rent. So he gave say 50,000 rupees as security deposit to the landlord so that the landlord can give that particular amount, give that particular property to the assessee for his business. Now the landlord also ran away. He also forfeited the amount. He did not run away, but he forfeited the amount because of some reason. Now whether that will be allowed as deduction, that will not be allowed as deduction because it's a capital loss. Because that 50,000 given to landlord was to acquire a capital right which is known as tenancy rights. And because you are acquiring a capital rights, what is the capital right? Because you are giving 50,000 to the landlord is giving you the right to stay in that property, which is the tenancy rights, which is the capital right. And that 50,000 was in relation to not revenue loss but capital loss, and therefore it shall not be allowed as deduction. It is as simple as that. Next, Delhi High Court judgment. What has happened in this case? The assessee is having a retail shop, and after the outside the retail shop there is a glow sign board. Now every shop has a glow sign board outside the shop. So expenditure incurred to buy that glow sign board, whether that will be considered as a capital expenditure or a revenue expenditure. The Delhi High Court held that it's a revenue expenditure because it does not bring into existence a capital asset. There is no permanency in that. It has a short shelf life. It decays with weather. It requires frequent replacement, and because of so many reasons, the Delhi High Court held that there is no point in capitalizing this asset and taking depreciation. Rather, it shall be allowed as a deduction in one shot in the form of a revenue expenditure. And one last case law over here is a very important one, 2018 Supreme Court judgment, whereby the assessee has raised some money through share application money from shareholders. Now that money is lying in a fixed deposit, for example. So assessee has raised 100 crores through share application money, and that money is lying in a fixed deposit in bank or in a saving account or a current account. And from that money, the assessee is getting some interest. Whether that interest will be taxable as IFOS, the Supreme Court held that this is not an IFOS income. The intention of that money, that interest, is not to earn interest. Therefore, that interest should be set off against the share issue expenses. So whatever is the expense incurred by the company against share issue, so that interest which is lying in the bank account, that will be set off against the share issue expense. This can be a very important adjustment in the sums also. In total income question also, they can ask you this particular adjustment. And then I have put certain general deductions also, certain general discussions also, that dividend paid will not be allowed as deduction, income tax, wealth tax, surcharge, health and education cess will not be allowed as deduction, provision for loss of subsidiary not allowed as deduction, deferred tax not allowed as deduction, diminution in the value of investments not allowed as deduction, provision for unascertained liability not allowed as deduction, prior period expenses not allowed as deduction prior period, but if the liability to pay that expense is crystallized in the current year, then it can be allowed as deduction. By default, prior period expenses are not allowed as deduction. But if the liability to pay that expense is crystallized in the current year, then that is not allowed as deduction. Salary and perquisites paid to directors are fully allowed, provided it should not be excessive, as per section 48.2, which will come in the next session. That is in the next lecture, not in the next lecture, but in the next 10 minutes. As per 48.2. Plus, directors' remuneration is subject to company law. There is a limit which is given in the managerial remuneration section under company law. It should not exceed that also. If it exceeds that, then excess amount shall be disallowed. Okay, just go through it once and then we'll move ahead towards our disallowances. So now let us go ahead with the next part, and the next part is about disallowances. And after we are done with deductions, all the deductions under section 30 to 37, now it is our duty to understand what are the disallowances which are there under the income tax law under the head PGBP. So mainly there are two types of disallowances which are there under the head PGBP. One is 40 capital A, another is 40 small a. What is the difference between the two? Why the government has categorized all the disallowances into two categories? Let us try to understand that first. Section 40 small a considers disallowances with respect to different kind of taxes. Like if you do not deduct TDS, if you do not pay tax, the wealth tax, the income tax and other kind of taxes which are getting disallowed over here. But section 40 capital A talks about disallowances where you are trying to avoid tax in some or the other way. Say maybe by making excess payment in cash, or maybe by making payment to relatives in excess of fair market value. All those things kind of tax avoidance cases are disallowed in 40 capital A. We are going to go in the order. We will try to understand first of all section 40 capital A. Let us try to understand 40 capital A subsection 2 first of all. What does subsection 2 has to say? Subsection 2 very clearly says that where an assessee incurs an expenditure, and in respect of an expenditure, if an assessee makes an excess payment to a relative or to specified person, then the excess amount will be disallowed. So if I am an assessee, I am incurring an expenditure and you are my related party, I am making an excess payment to you. Excess as compared to what? As compared to the fair market value, as compared to the legitimate needs of the business. Excessive and unreasonable payment I am making, then the assessing officer will disallow the excess amount. Only excess amount is disallowed. Suppose if I am making you a payment of 1,50,000 rupees and the fair market value of that particular expenditure is say 1 lakh, then extra 50,000 will be disallowed under section 40 capital A subsection 2. What is disallowed over here is payment. What is added back over here is a payment in relation to an expenditure. Now take an example. Suppose I am a company, you are a director. And director and company are considered to be related party as per income tax law. So if I am a company, you are a director, I am making you a sale of goods and you are giving me some amount. Say I have sold some product to you, to the director, to my related party. He has given me 1 lakh rupees. Now the fair market value of that product is 1,50,000 rupees. Now will that extra 50,000 be added in 40A2? The answer is no. Because this extra 50,000 is not an expenditure. It's an income. So for income, there is no section. For expenditure, there is a section. So over here, if I make an excess payment, then there is an expenditure which is disallowed under 40A2. But if I receive less payment, then that is not added back in the Income Tax Act. But ICI has made a mistake in this particular solution in some of the solutions. So don't do that mistake in life. Even in exam, you should not repeat that mistake. That is a mistake done by ICF. Section moral of the story. I would like to just conclude with this line. 40A2 applies to expenditures and payments and not to receipts. It's not applicable to receipts. It's applicable to expenditures. It is very clearly written in section 40A subsection 2. Now let us go ahead with the next section, and a big one and a very important one. Section 40A subsection 3, which talks about if an assessee incurs a revenue expenditure. 40A3 is only for revenue expenditure. It is not for capital expenditure. For capital expenditure, there are already separate sections. I'll again speak about them once again. So if you are incurring a revenue expenditure and if you are making a payment with respect to that revenue expenditure to a person in a day, to one person in a day, then you should make the payment by account pay check, account pay draft, ECS, or such other electronic mode as may be prescribed. Sir, what is that such other electronic mode as may be prescribed? Has the government prescribed? Yes, the government has prescribed under Rule 6A BBA. And such other electronic mode would include credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT, BHIM. These are the category of payments which are covered in such other electronic mode. Please keep these things in mind because this phrase will come again and again. Account pay check, account pay draft, ECS, such other electronic mode as may be prescribed. It comes around 12 to 13 times under income tax law at different places. So you have to keep this thing in mind. So if you are making a payment to a person in a day, if you are making payment to two persons in a day of say 8,000 to one person, 8,000 to another person in cash, it is allowed. But if you are making payment to one person in a day, morning 8,000, evening 8,000, total 16,000, the kharcha will be disallowed, the expenditure will be disallowed. And here the entire expenditure gets disallowed and not the expenditure in excess of 10,000. Suppose if you make a payment of 16,000 cash to a person in a day, then entire 16,000 will be disallowed and not 6,000. Unlike the previous section, in the previous section only the excessive portion was getting disallowed. But in this section, the entire amount will get disallowed. Okay. Please be very careful about it. So if you want to get your expenditure allowed, revenue expenditure allowed, you have to make the payment to a person in a day. If in excess of 10,000 by account pay check, account pay draft, ECS or such other electronic mode. Sir, cash will be allowed, cash would not be allowed. Sir, bearer check would be allowed, bearer check would not be allowed. Sir, cross check will be allowed, cross check will also not be allowed. Not be allowed. The cross check has to be an account pay cross check. The check has to be crossed and it has to be written between that account pay on the top. Then only a cross check is called as, because the law uses the word account pay and not cross check. So cross check not allowed, merely cross check not allowed, bearer check absolutely not allowed, cash is no question only. Account pay check, account pay draft, such as electronic mode, ECS. These are the modes which are allowed over here. For transporter, if you are making a payment to a road transporter, the limit is 35,000 instead of 10,000 rupees. If you are making a payment to a road transporter, then the limit is 35,000 instead of 10,000. Okay. Now, 48.3, the way 48.3 is there, the similar section is also there, 48.3a. Now, what does 48.3a has to say? Let us try to understand. This is previous at 21, 22. I am recognizing one expenditure. I am just booking. I am accruing one expenditure salary to outstanding salary. And in the next year, I am making the payment of that salary by cash. What will happen in the next year? Nothing. It will be considered as added back to the income and it will be deemed income of the next year. It will be deemed income of the next year. As simple as that. So if your expenditure is accrued in 1 year but paid in another year, then also 48.3a is applicable. And if your expenditure is accrued in the same year and also paid in the same year, then 48.3 is applicable. So try to understand the differentiation. If expenditure accrued in the same year and paid also in the same year in cash, then 48.3. If accrued in 1 year, paid in another year in cash, then 48.3a, you have to consider that as a deemed income. That's the only difference, nothing great. Now the next part I have already explained you. Where, sir, where? While teaching you 35AD and while teaching you depreciation, I have already told you. Okay, in case of 35AD assets also, if you want to make a payment for an asset to a person in a day, then you have to make the payment by account pay check, account pay draft, ECS or such as electronic mode. Even in case of acquiring a fixed asset to claim depreciation. If you want a depreciation on fixed asset, then you have to acquire the asset by making the payment to a person in a day by account pay check, account pay draft, ECS, such as electronic mode if the payment is in excess of 10,000 to a person. Okay. So this is something which we have already done in 43.1 and section 35AD. Now, Rule 6DD exception. Now, what does this exception has to say? The complete list of exception is not in this particular book, but I am speaking on behalf of you. All the important ones. Government has given an exception list in Rule 6DD, whereby the government has said that if you make the payment to the following persons, then 48.3 is not applicable. It means you can make the payment as much as you want in cash. There is no harm. So who are those lucky people? First, if you make the payment to government, it is allowed. If you make the payment to LIC, it is allowed. If you make the payment to RBI, it is allowed. If you make the payment by way of debit card, credit card, or by way of book adjustment. So what is book adjustment? I have to make you a payment of 30,000. You have to make me a payment of 20,000. Let us adjust. That is book adjustment. I am supposed to make you a payment of 30,000. You are supposed to make me a payment of 20,000. Let us adjust. This is book adjustment. This is allowed. If you make a payment to a person who resides in a village or town, there is no banking facility. It is allowed. You can make cash payment. If you make a payment to an agent to acquire goods on behalf of you, it is allowed. Like a consignment agent. If you make a payment to a foreign currency dealer because you want foreign currency, it is allowed. You can make payment in cash. If you make a payment on a public holiday, it is not allowed now. Earlier, if you earlier till 2020, if you would have made a payment on a public holiday or the day on which the bank was on strike, it was allowed. But now it is not allowed. Now it is disallowed. Even if you are making a payment on public holiday, you have to make by account pay check, account pay draft, ECS or such an electronic mode. Henceforth, I will be speaking this as 4 modes. If you make a payment to employee for retrenchment compensation, VRS compensation, another kind of compensation, you can make the payment up to 50,000 in cash. For them, the limit is 50,000. If you make a payment to an employee for retrenchment compensation, VRS compensation, this, that, different kind of compensation you are making to the employee, then you can make the payment till 50,000 in cash. The limit is increased till 50,000 in that case. If you make the payment to an employee of salary who is going outstation for 15 days or more, and the place where he is going, he does not have a bank account over there, and the payment which is made to him, from that you have deducted the TDS. If you fulfill all 6 conditions, then there is no need to pay by check. You can make the payment by cash also. The expenditure will not be disallowed. I am again repeating, this is an important one for exam. If you make a payment to an employee who is going outstation for 15 days or more, his TDS is deducted. He does not have a bank account over there. Okay. Then you can make the payment in cash. There is no harm. Okay. It's allowed. If you make a payment to cultivator, grower or producer, listen carefully, cultivator, grower or producer of agriculture product, animal husbandry, dairy product, poultry farm, fish and fish product, apiculture, horticulture, these are the products which you are buying from whom? Either a grower, producer or cultivator of these products. You can make as much payment as you want in cash. It's allowed. It's absolutely allowed. So from whom? If you buy the product from grower, cultivator or producer of agriculture product, animal husbandry, even forest product, fish and fish product, dairy product, poultry product, apiculture, horticulture. Apiculture is in relation to honeybee. Horticulture in relation to plants. If you buy these products from these three people, producer, grower or cultivator, it is allowed to be paid in cash. If you buy from a dealer or a shopping mall, if you go to shopping mall and buy from there these products, then it is allowed. It is not allowed. You have to make the payment by account, pay, check, draft, TCS. Okay. Now in that, there is one query which was raised by the industry, and the query was, what do you mean by fish and fish product? Fish and fish product will include what? The government has clarified that fish and fish product would include other marine products like shrimp, like prawns, like cuttlefish, like lobster, like crabs, like squids, etc. Because the word fish is a very, very, very specific word. Will it include prawns also? In reality, fish is different, prawns is different. Fish is different, crab is different. But in the language of the law, fish and fish product will include all of them. All marine products. Don't worry. Secondly, who will be called as a dealer? Who will be called as a producer, grower or cultivator of fish or fish product? Who will be called as that? So that is also clarified. The government has said the fisherman will be called as the grower, producer or cultivator of fish and fish product, or the headman of the fisherman. There is a headman who sorts all the catch of fish. There is one person who is called as headman, who takes all the fishermen and let them go inside the sea and catch the fish. All the fishermen go in the sea, catch the fish, give to the headman. And then headman go to the industry, in the market and sell to the people. So even if you buy from headman or directly from fisherman, both the cases, it is allowed. If you buy from anybody except these two people, that is the headman and the fisherman, then 48.3 would be attracted in your case. This is what this particular section is all about, and rule 60D exception is all about. I have told you almost all the exception which is relevant for your exams. Okay. Now there is one circular over here. I am keeping this circular on hold. I will be discussing this circular after we are done with section 269 ST. Once we are done with 269 ST, we will be dealing with this circular. Don't worry about it. Okay. Next one. Let us talk about one interlinking which can come in exam between 48.2 and 48.3. What interlinking, sir? The interlinking is as follows. Suppose there is a related party to whom I am making some payment in cash. So if a related party is there to whom I am making payment in cash, then the question of 48.2 will also arise, and for question of 48.3 will also arise, because the other party is related party, therefore 48.2 will attract, and the other party who is related party, I am making the payment in cash, therefore 48.3 will also attract. So suppose I made a payment of salary of say 1 lakh rupees to my related party, and the fair market value of that salary is 92,000. So how much excess I am making the payment? 8,000. So what shall I do? I am making a payment of 1 lakh rupees instead of 92,000. The fair market value is 92,000. I am making a payment of 1 lakh, that too in cash. So 48.2 will also attract, 48.3 will also attract. Then how to apply the provision? Then in that case, the law says that you have to follow the order of the law. The section which came first has to be applied first, and the section which came later has to be applied later. So which section came first? The section which came first is obviously 48.2. The order of the law has to be followed. So 48.2, how much you have paid? 1 lakh. What is the fair market value? 92,000. Therefore, 8,000 will be disallowed under 48.2. Now let us see the balancing amount. How much is the balancing amount? Balancing is 92,000 rupees. Now is that paid in cash? Yes, it is paid in cash. So now 48.3 will also attract. Therefore 48.3, 92,000 will be disallowed. In short, you have to bifurcate 1 lakh into two sections, 8,000 under 48.2 and 92,000 under 48.3. What would be the situation if this case is reversed? Let us make an example. Suppose you are my related party and I am making you a payment of 1 lakh rupees in cash, and the fair market value of that transaction is just 8,000 rupees. Now what will happen? So if the FMV is 8,000, I am making you a payment of 1 lakh rupees, then again have to apply the law, rule of the law. I have to follow the order of the law. 48.2 will apply. In 48.2, fair market value is 8,000. Actual payment is 1 lakh. 92,000 will be disallowed in 48.2. Now what is left? What is left is just 8,000. Now you come to 48.3. In 48.3, I cannot disallow 8,000 because the limit of 48.3 is how much? The payment has to be in excess of 10,000. Therefore, in this case, only 92,000 will be disallowed in 48.2. Nothing would be disallowed in 48.3 because for amount which is left, listen my words carefully. The amount which is left in 48.3 does not exceed the threshold mentioned in 48.3. I hope it is clear to all of you. Okay. Next, 48.4. What does it has to say? It is a very specific provision which protects section 48.3. Let me explain you with an example. Suppose I am a buyer, you are a seller, and we enter into a contract that I will buy a product from you after 2 months. You will sell me a product after 2 months and we are entering into a contract, and in the contract seller is insisting me to put a clause that I will make the payment by cash. Seller is insisting me that I will make the payment in cash. I also wrote that I will make the payment in cash and I signed the contract. After 2 months when I had to make the payment, I did not make the payment in cash, but I made the payment in account paycheck, because I know that if I made the payment in cash, then my expenditure will be disallowed in 48 weeks. So I made the payment in I made the payment in check instead of cash, even though it is written in the contract that I should make the payment in what? I should make the payment in cash. But still I made the payment by account paycheck. So now what will happen? Will the other person file a case on me? And if he files a case on me, will that case exist in the court of law, or it will be quashed away by the court? So on this matter, section 40A4 will protect. In practical life, if you go and open section 40A4, it is written that 40A4 says that notwithstanding anything contained in the income tax law or any other law for the time being in force. So this section overrides all the laws in this country, and it says that even if it is written in the contract that you should make the payment in cash, and if you made the payment by check, nobody in this world can file a suit against you. Even if it is written in the contract that you should make the payment in cash, and you are violating that contract by making the payment in account paycheck to protect the spirit of section 48(3), nobody in this world can put you in jail, or nobody in this world can file a case against you or file a suit against you. Therefore, this section tells you, violate the contract. Don't worry. Even if you violate the contract, that contract has no validity. If you are violating the contract to protect section 48(3) and you are violating the contract to make the payment by account paycheck, account pay draft, ECS, such as electronic mode, it is allowed. Don't worry about it. Okay. Just go through it once and then we'll go ahead. Now let us talk about the next one, that is 40A7. What is 40A7? This talks about disallowances for provision for payment of gratuity. So now in a company, if you want to make a payment of gratuity to the employee, you have to hire an actuary, and whenever an actuary comes and makes a provision and actually tells you that this much amount has to be paid to the employee, so you have to make a provision for that. So when you make the provision, you don't get any deduction of that. But when you make the actual payment to the employee of that particular amount, you will get the deduction of that. Don't worry about it. So moral of the story is very clear. On a provision basis, it is not allowed. On actual payment basis to the employee, it will be allowed as deduction. Okay. Next one, 40A9. 40A9 talks about if you contribute to an unrecognized provident fund, then it shall not be allowed as deduction. Okay. So if you contribute to a recognized provident fund, then it is allowed as deduction under section 36, subsection 1, clause 4, which we have seen earlier only. But if you contribute to an unrecognized provident fund, then it is not allowed as deduction. But one good news over here is, when you contribute every year, you will not get any deduction, because section 40A9 will disallow that. But actually, when you make the payment to the employee, say after 10 years, so you will contribute every year, say 1 lakh to the employee's contribution in an unrecognized provident fund. So on actual contribution, it is not allowed as deduction. But when you withdraw the amount from the fund and give it to the employee, it will be allowed as a deduction in a lump sum in the year of actual payment. So these are the 5 sections which were there in section 40 capital A. Now let us move on to the section 40 small a. Small a, the first thing which we need to understand over here is the TDS implications. When you make a payment to any resident or even to non-residents, and the income is chargeable to tax in the hands of the other person, then you have to deduct TDS, you have to pay TDS. If you do not deduct TDS, and if you deduct the TDS and if you do not pay the TDS, then there are serious implications under the income tax law. And one of the serious implications is that the expenditure can be disallowed under the income tax law in the hands of the assessee. So first of all, we are dealing with section 40A subclause 1. Okay. In this, you are making payment to a non-resident or a foreign company whose income is chargeable to tax in India. Now, this is a very important place. You are making payment to whom? A non-resident. You are making payment to whom? A foreign company. But at the same time, it is important that the income of that non-resident and that foreign company, that is the pay company, pay non-resident, has to be chargeable to tax in India. Merely because you are making a payment to non-resident or foreign company, it does not mean that you have to deduct TDS. The other person's income has to be chargeable to tax in India. So if the other person's income is chargeable to tax in India, and if you do not deduct the TDS in the previous year, or after deducting the TDS, you do not pay the TDS, then the expenditure will be disallowed in the current year. So is it a permanent disallowance? The answer is no. It is not a permanent disallowance. It is a temporary disallowance. It means if it is disallowed in the current year, it can be allowed in the next year if you pay in the next year. So if you pay in the next year, then it will be allowed in the next year. If you pay next to next year, then it will be allowed in the next to next year. If you pay after 5 years, then it will be allowed after 5 years. Don't worry about it. It is not a permanent disallowance. It is a temporary disallowance. So what ideally I should do? Ideally, you should deduct before the year ends. You should deduct before the year ends. Deduction has to be done in the current year. That is the first condition. So after you deduct in the current year, then you have to make the payment till the due date of filing of return. So deduct in the current year. If you make 1 day delay in deducting, say instead of deducting on 31st of March 2022, you deduct on 1st of April 2022. Then in this year, you cannot ask for deduction only. Then the expenditure will be disallowed. So the deduction has to be made in the current year, but the payment can be made till the due date of filing of return. If you do that, you will be allowed the expenditure in the current year. If you do not do that, then the expenditure will be allowed in the year in which you actually deduct and pay the expenditure, that is in the subsequent years. Okay. So it's not a permanent disallowance, it is a temporary disallowance. Okay. Now, there are a few small things which we need to understand over here. First of all, this is one CBDT circular which we need to understand over here. And this is a very important circular. Sir, how much expenditure will be disallowed if I do not deduct, do not pay? 100%. When you make the payment to non-resident or foreign company, 100% expenditure is disallowed. When you make the payment to residents, then only 30% is disallowed. Okay. So this is the differentiation which the government has kept when you make the payment to a non-resident or when you make the payment to a resident. Okay. So here we are making the payment to non-resident, not deducting the TDS, 100% will be disallowed. Now, one of the important things which I have said you just now, that the other person's income has to be chargeable to tax in India. Then only you have to deduct TDS. Now, suppose I am making a payment of 10 lakh to the other person. Now, that person's income has to be chargeable to tax in India. Then the question of TDS arises. Then the question of TDS disallowance arises. What if the other person's income is not chargeable? Do not deduct. Do not deduct. Doesn't make any sense. Now, there is something in between also. What if the other person's income is partially chargeable to tax in India? Then what to do? Then in that case, the government has made a special provision. If the other person's income is partially chargeable to tax in India, then assessee, that is the payer, that is the deductor, has to make an application to the assessing officer in section 195 subsection 2, and the assessing officer will determine the appropriate portion on which the TDS has to be deducted. Suppose if I am making a payment of 10 lakh rupees to the other person, the entire income is not subject to tax in India. Only 40% income is chargeable to tax in India. Then the assessing officer will determine how much percentage is chargeable to tax in India. You cannot decide. Suppose the assessing officer decided that 40%, then you have to deduct TDS on that 40%. That is on 4 lakh. If you do not deduct TDS on that 4 lakh, then only 4 lakh will be disallowed. 10 lakh cannot be disallowed. This is what is written in this particular circular. Okay, I hope it is clear to you. Now, coming to 40A, clause A, subclause 1A, when you make the payment to residents, everything is same, except one change. And that one change is, if you make the payment to residents, again you have to deduct in the same year. You have to make the payment till the date of filing of return. If you do not do this in this year, this is the temporary disallowance you can do in subsequent years. And then it will be allowed in the next year. Don't worry about it. But here, the thing is, the disallowance will be restricted to 30% of your expenditure. It cannot be more than that. When you make the payment to non-resident, it is 100%. Here it is 30%. Apart from that, everything else is same. Now, there is one point over here, which is also covered in the previous section, which is over here also. So, I am speaking about both of them together. Okay. Now, generally what happens, I am a deductor, you are a deductee. If I do not deduct TDS and if I do not pay TDS, then the assessee is called as assessee in default as per section 201 subsection 1. And then there are serious consequences against the deductor. Deductor can also be prosecuted. He can also be sent to jail for a minimum of 3 months and maximum of 7 years. Prosecution. That can also happen. When? If an assessee does not deduct TDS and does not pay TDS, then the assessee is called as assessee in default. But there are a lot of high courts who have objected this particular thing, and then the income tax law also came up with a provision, and they have said that the assessee has not deducted TDS, the assessee has not paid the TDS. But if the other person has included that income in his return and has paid tax on that and has filed the return, then the assessee will not be called as assessee in default. It means I am a payer, you are a payee. I am supposed to deduct TDS. I am supposed to pay TDS, but unfortunately, I did not do that. But you have paid tax on that. You have included that income in your ITR and you have filed the ITR. Then it is deemed that I have only deducted. It is a deeming fiction which says that I have only deducted, I have only paid the tax, but on which date? On the date on which you have filed the return. So in that case, my disallowances cannot happen. So I have not, in reality, I have not deducted, I have not paid. But you have included that income, you have paid tax, you have filed RTR. So it will be deemed that I have only paid, I have only deducted. On which date? On the date on which the payee has filed the return. So that the disallowance should not happen in the hands of the assessee. But will the assessee be liable for interest? Yes. Assessee will be liable for interest, only one interest under 201 subsection 1A, that is 1% per month or part thereof, that's it. Generally, if an assessee does not deduct and does not pay, then the assessee has to pay 2 types of interest for non-deduction. One for non-deduction, 1% per month, and one for non-payment, 1.5% per month. But here, in this special case, there is only one interest, that is 1% per month. From which date? From the date on which I was supposed to deduct TDS till the date of filing of return, I have to pay that much period ka interest. Okay, I hope it is clear. And this provision is applicable for 40A1A also and 40A1, that is the previous section also. It is applicable for both the sections. Okay. Now, there is one clarification which was very much needed, which was given by the landmark judgment of Supreme Court in the case of Palam Gas Service in 2017. What is this clarification all about, sir? Now, listen carefully what this clarification was all about. There were 2 issues which was raised by the assessee. First, The SSC was saying that what is written in 40A1 and 1A, you know that the TDS has to be deducted on amount payable. If an amount is payable, on that amount TDS has to be deducted. It is written like that. So SSC has started to make a strict interpretation of this phrase payable, and he said that I am liable to deduct TDS only if the amount is payable. I am not liable to deduct TDS if the amount is actually paid, because the law says that TDS has to be deductible on the amount payable. So SSC started making a strong interpretation, a literal interpretation of the word phrase payable. He started saying that first issue, the first query which he raised is, he started saying that I am supposed to deduct TDS only on the amount which is payable by me and not the amount on which is paid by me. Supreme Court said that no, the word payable would include paid also. Second, the SSC started saying that because the word payable is used in 40A1 and 1A, I am supposed to deduct TDS only if I am following a mercantile system of accounting. It means I am not supposed to follow TDS if I am following a cash accounting system. Because in cash accounting system, the concept of payable is not there. In cash accounting system, there is always a concept of paid and receipt. Again, the Supreme Court held that no, TDS deduction has nothing to do with method of accounting. If you are following a mercantile system, then also you have to follow TDS provision. If you are following a cash accounting system, then also you have to follow the TDS provisions. So both this particular queries which was raised by the SSC fell to ground as per after the Supreme Court judgment of 2017 of Palam Gas Service. Okay, I hope it is clear to you. It's an important one, very important one. Now there are certain small disallowances. Let us talk about one by one. First of all, income tax is disallowed, including the surcharge and cess and everything. Everything is disallowed. Okay. Wealth tax is also disallowed under section 48(2)(a). Income tax disallowed under 48(2). Wealth tax disallowed under 48(2)(a). Now, even though in India today the concept of wealth tax is not there, but anyways, you can pay wealth tax globally also. Anywhere you pay, including India or outside India, it will be disallowed. Next, if you pay any royalty, fees, service charge, etc., which is paid by state government undertaking to state government. Paid by whom? Paid by, say, Maharashtra state government undertaking to Maharashtra government. Then it is disallowed. Then it is disallowed. Okay? There is nothing great in this. Not much important. So, paid by whom? Maharashtra state undertaking. To whom? To Maharashtra state government. It is disallowed. It is only applicable to state governments, not to central government. And last but not least, if an employer is paying tax on non-monetary perquisites of the employees, I am an employer, you are an employee, and I gave you a furnished accommodation. And on that furnished accommodation, I am paying your tax. I am bearing your tax. So that tax will be disallowed in my hand, and then the perquisite will be exempt in your hands under section 1010(c). But the tax will be disallowed in my hands. The tax portion, not the perquisite portion. Perquisite portion will be allowed as an expenditure, but the tax portion will not be allowed as an expenditure, and that particular perquisite will be exempt in the hands of the employees. I hope it is clear to all of you. Now coming to the big one and the most important disallowance out of all of them, and that is 43B. 43B says that there are certain expenditure, around 6 to 7 expenditures, which will be allowed on actual payment, actual payment, actual payment. It will not be allowed on accrual system. It will not be it is irrespective of the method of accounting followed by the SSC. It is not necessary which method of accounting you are following. In these cases, you have to be allowed an expenditure only if you make an actual payment. So by which date I should make up the payment, sir? You can make the payment if the expenditure is of the current year. If the expenditure pertains to the current year, you can make the payment till the due date of filing of return. It's allowed. So what all things are covered? The first thing, tax, duty, cess and fee. Tax, duty, cess and fee. That is the statutory dues will be allowed on actual payment. Okay, which tax? Like GST, import duty, etc. All these duty, cess, fee. Statutory dues, if it is allowed as deduction, it will be allowed under 43B on actual payment, not on accrual. Second one is a very important issue. Employer's contribution, not employees. I have already clarified to you. And even Finance Act 2021 has clarified that employees' contribution has to be made as allowed as deduction only if it is paid by 15th of the following month. But employer's contribution has to be allowed as deduction even if it is paid by what? Till the due date of filing of return. Employer's contribution till the due date of filing of return as per 43B, because 43B only covers employer's contribution. It doesn't cover employee's contribution. And employee's contribution will be allowed if it is paid before the fund's due date, that is the 15th of the following month. Okay. Third, bonus or commission to employees will be allowed on actual payment. Fourth and fifth, interest on loan taken from public financial institution, state financial corporation, state financial industrial investment corporation, any loan taken from scheduled bank, cooperative bank, NBFCs. All of them will be allowed as deduction only if the actual payment is made of interest and not on accrual basis. So what about if I take a loan from foreign bank? If you take a loan from foreign bank, it can be allowed on an accrual basis because foreign bank is not covered here. Foreign bank not covered. And leave salary. And last but not least, any expenditure which is made to Indian Railways. If you are making any payment to use certain assets of Indian Railways, then if you are taking services of Indian Railway, you are making any payment to Indian Railway, then it will be allowed on actual payment, actual payment, actual payment. By when I should make the payment? You can make the payment till the due date of filing of return under section 139 subsection 1. It's allowed. Is it a temporary disallowance or is it a permanent disallowance? It is again a temporary disallowance. If you do not make the payment in the current year, then the expenditure will be disallowed in the current year, but it will be allowed as deduction in the subsequent year. That is the year in which you make the payment. Okay. Now next is, suppose I have to make a payment of GST. Now GST will be allowed on what basis? An actual payment basis. Now I have not made the payment of GST, but instead I gave a bank guarantee to the government. So will that bank guarantee amount to actual payment? The answer is no. Bank guarantee does not amount to actual payment. Actual payment means you should take the money out of your pocket and give it to the government. Then it can be considered as actual payment. So merely giving a bank guarantee will not be allowed as deduction over here. Don't worry about it. Okay. Now why I'm picking up some small points, because these are the small points which have been asked as an adjustments in a lot of questions in the exam. So the smallest of the points which have been asked in a question, which has been asked as a question, which has been asked as small adjustments in your total income question, I'm trying to cover over here. Because in PGBP, in business and profession, what will come is a complete full-fledged question. Question number 1, compulsory question, 14 marks for computation of total income. So in that, you need to know the minute details of each and every adjustment which can possibly come in the exam. So that is the reason we are trying to cover smallest of the things in this revision video. Okay. Anyways, GST can be inclusive, it can be exclusive, it doesn't matter. It will be allowed only on actual payment. If the turnover is inclusive of GST or the turnover is exclusive of GST, it doesn't matter. You have to consider that as what? As a part of 43B, and it will be allowed on actual payment basis. Okay. Otherwise, it will not be allowed. This is something which I have clarified just sometime before in today's lecture itself, at the beginning of the lecture, that now if the employee contribution has to be allowed as, because employee contribution first it is considered as an income and then it is allowed as deduction when you make the payment. So by when I should make the payment? By next of 15th. That said, you cannot make the payment till the due date of filing of return for employees contribution. That provision, that logic is applicable for employers contribution. Okay. Now let us talk about this. This is again a very important part. What does it talks about? Suppose I have taken a loan from SBI, and on that loan there is some outstanding interest also. Now that outstanding interest will not be allowed as deduction because it is outstanding, and outstanding interest is not allowed as deduction unless and until it is paid. Now I don't have money to pay that particular outstanding interest, so I'm going to bank and I'm converting that into a new loan. So that outstanding interest is now getting restructured and it is getting converted into a new loan. So will that be allowed as deduction? So conversion of an outstanding interest into a new loan, will that be considered as an actual payment? The answer is no. The government has given an explanation over here to section 43B in the form of explanation 3C, 3CA and 3D. 3C for what? 3C for this particular point, 3D for this particular point, and 3CA for what? For NBFC. That is the reason 3C, 3CA and 3D, these are the three explanations which the government has given for you. And what does this explanation say? This explanation very clearly clarifies that conversion of an outstanding interest into a new loan does not amount to actual payment. It is not an actual payment. It will not be allowed as deduction now. But CBDT circular comes into picture and tries to protect the assessee, and which says that later on, whenever you will make a payment of that new loan, then that time you will be allowed the deduction of that particular expenditure. Suppose there is an outstanding loan, there is an outstanding interest in the balance sheet of 10 lakh rupees. So now you are converting that into a new loan. Now the outstanding interest is gone and a new loan is appearing in the balance sheet for 10 lakh rupees. Nothing will be allowed as deduction, merely on conversion. So when you make the payment of that 10 lakh rupees loan to the bank, at that point of time, it will be allowed as deduction to the assessee. Don't worry about it. Okay. Next, a very important Supreme Court judgment of Sassoon Chemicals and Drugs Limited, latest one, just came few years back, which talks about what? Let me tell you the facts. There is an assessee, Sassoon Chemical, which is making payment to the employees as bonus. Now we all know that bonus and commission will be allowed as deduction under section 36, subsection 1, clause 2, but subject to 43B. It cannot be directly allowed. So it has to be allowed subject to 43B. You have to make actual payment. Now what is the trust doing? What is the company doing? There is some dispute which is going on between the company and the trust. So what the company is doing? There is some dispute which is going on between the company and the employees. So what the company is doing? Company is making a trust and company is making payment to that trust. Company is not making the payment to employee because dispute going on. So company is making payment to that particular trust. And the dispute got resolved and then the trust made the payment to the employees before the due date of filing of return. Everything happened before the due date of filing of return. Dispute happened before the due date of filing of return. I formed the trust before the due date of filing of return. And even the trust made the payment. Dispute got resolved before the due date of filing of return. And even the trust made the payment before the due date of filing of return to the employees. Will that be allowed as deduction? And the answer is definitely yes. There is nothing in this world who can stop you to claim deduction of this particular expenditure now. Don't worry about it. Okay. So this is what the disallowances are all about. This is where all the disallowances of income tax law under the head PGBP gets over. Okay. Now one disallowance is pending. I'll be talking about that sometime later. That will be coming up with the discussion of what? Equalization levy, which will come in the later part of the revision. Okay. Not today. not tomorrow, not in the next few sessions. Coming to the next chapter, and that is about deemed incomes. Now we have seen some deemed income sections. Let me show you what. We have seen 41.2 balancing charge, if you remember. We have seen 41.3 if you sell a scientific research asset. We have seen 41.4a. See the interlinking. Whatever we have done, that also I have put over here so that you have a complete overview, a bird's eye view of the entire subject. So we have seen 41.4a, when you withdraw the amount from special reserve account created under section 36(1)(8), then it is deemed income. We will see, future also I am putting over here, we will see 41.5 later on in the chapter of set off and carry forward. So what is left now out of these sections? What is left out of these sections is 41.1 and 41.4. Because 41.2 we have already done, 41.3 we have done, 41.4 we have done, 41.5 we will be doing later. So 41.1 and 4 we will try to understand here. Okay, what is 41.1? 41.1 talks about recovery of expenditure or remission or cessation of trading liability. Now what does it talks about? Let me tell you one by one clearly. Suppose if you have incurred some loss or you have incurred some expenditure in past. Okay, so you would have taken deduction of that particular expenditure and deduction of that particular loss in earlier year. Now in the current year, there is a recovery of that loss or there is a recovery of that expenditure, then it is deemed to be income. It is as simple as that. In earlier year, you have claimed one deduction and now in the current year, you are recovering that deduction. So you have to pay tax on that. It is as simple as that. This is what section 41 subsection 1 has to say. Now, section 41 subsection 1 has one more area, one more aspect, which talks about remission or cessation of trading liability. It means if you take any trading liability or if you have any trading liability in the balance sheet and the other person forgoes that trading liability, it remits that trading liability, the trading liability ceases to be liable, then in that case also it shall be deemed income. Now, what is an example of trading liability? Suppose if I take a loan from bank for working capital purpose and that bank, because working capital purpose is a trading purpose. Suppose if I take a loan from a bank for working capital purpose and the other bank, that is the loan giver, waives of that particular loan, then in that case it is my profit and therefore it's a remission and cessation of what kind of liability? A trading liability, and therefore it will be chargeable as income under section 41 subsection 1 for me. But at the same time, if I take a loan from bank for the purpose of fixed asset and that bank does what? Does a waiver, then it cannot come under 41.4. It cannot come under 41.1, sorry, because that is not a remission or cessation of a trading liability. It's a remission or cessation of a capital liability, because the loan is not taken for the trading purpose like working capital purpose. The loan is taken for the purpose of acquiring fixed asset. But in that case, we have done something earlier. Let us do a great interlinking. If I take a loan from bank, for the, I'm telling you very clearly, this is slightly confusing part. If I take a loan from bank for the purpose of fixed asset and the bank waives that loan, it is not covered in 41.1 because it is not a remission or cessation of trading liability. This is one aspect. Let us talk about the second aspect. Suppose if I take that loan from bank, suppose if I take that loan from government, central government or state government or body or authority or agency, and if that loan is waived off, will that be chargeable to tax? The answer is yes, under section 2418. Do you remember that? Do you remember that? But at the same time, if I take that capital loan from a bank or a company or a firm LLP, then it is not chargeable to tax. We have already discussed this particular thing in the chapter of depreciation. I hope it is clear to all of you. Now, 41.1. Is 41.1 applicable even after the business is ceased? Yes. 41.1 will be applicable even after the business is closed. Okay. Second, 41.1 will be applicable even in the hands of the successor. Example, if the predecessor is there, amalgamating company has incurred the expenditure and the expenditure is recovered by the amalgamated company, then it is taxable in the hands of the amalgamated company as per this particular clause. Clear? Further, section 41.1 is also applicable in case of unilateral cessation of trading liability. What do you mean by unilateral cessation of trading liability? Unilateral means one-sided cessation of trading liability. It means what? Suppose there is a buyer who has purchased some goods, who has sold some. Suppose there is a buyer who has purchased some goods and there is a seller who has sold some goods. Now, there is some dispute between the two. And the buyer is saying that I will not make the payment. And the seller is saying that I will receive the payment. Seller is saying I have to receive the payment from you. I have done everything correct. Buyer is saying that your product is not proper. I will not make the payment. So buyer is unilaterally seizing the liability. Will section 41.1 be attracted? The answer is yes. Seller is not seizing that particular liability, but the buyer is seizing that liability. Will the 41.1 be applicable? The answer is yes. 41 subsection 1 will be applicable in this case also. Even in case of unilateral cessation of trading liability, 41.1 is applicable. I hope it is clear to all of you. Next, a very important Supreme Court judgment in the case of Polyflex India Limited versus Commissioner of Income Tax. It's an old judgment, but it's very important. What has happened in this case? Let me tell you very clearly the facts of the case first of all. The facts of the case talks about there is an assessee who has lost some case in excise. So it has to make the payment of excise duty. There is a notice which has come from excise department. So what assessee did? Listen, assessee paid the excise duty, took the deduction because excise duty is allowed as deduction on actual payment. And then it filed a case. Matter went to High Court. In High Court, assessee won the case. Because assessee won the case, assessee got the refund of excise. And because assessee got the refund of excise, the department was aggrieved and department filed the case in Supreme Court. In the meanwhile, assessee got the refund of excise and the matter is in Supreme Court. because High Court has given the judgment in the favor of assessee. So assessee got the refund. But the department has filed a Supreme Court judgment, a Supreme Court appeal. So let us see where we stand. We are standing at a position where the matter is sub judice in Supreme Court, but I have received my refund as of now. So will that be subject to 41(1)? Assessee started raising an objection that it will not be subject to 41(1) because the matter is already sub judice in higher authority. Let Supreme Court give its verdict. Whatever verdict Supreme Court will give, then accordingly we will do the adjustments. But the assessing officer says that what Supreme Court will say, it has nothing to do with what has happened today. What has happened today? You have received the money. So you have to pay tax on 41(1) deemed income because you have claimed deduction earlier while making the payment. So at the time of refund, it will be considered as deemed income. So the Supreme Court in the case of Polyflex India Limited has held that 41(1) is attracted the moment an expenditure which was claimed as deduction is recovered by the assessee, irrespective of the matter, whether the matter is sub judice in the higher court or not. If the matter is sub judice in higher court, it doesn't matter under 41(1). Today, if you have received the refund, you have to pay tax on that amount. Later on, whatever will happen, we will see in future. But 41(1) will be attracted if you receive the money. Suppose if the High Court has passed the order, but assessee has not received the money, then 41(1) cannot be attracted. The assessee should have received the money. Suppose High Court has passed the order in the month of March, but assessee received the money in the month of April, then tax will be imposed in the month of April, not in the month of March. You have to be clear with that particular point also. Okay, this is what section 41(1) is all about. Let us talk about the one last section over here, 41(4), which is very straightforward. That if you have claimed a deduction of bad debts earlier under section 36(1)(7) and later on that bad debts is recovered by the assessee, then it will be deemed income under section 41 subsection 4, irrespective of whether the business exists or not. If the business exists, then also it is taxable. If the business does not exist, then also it is taxable. Okay, and your Supreme Court judgment over here. But in case of successor, it is not chargeable to tax. Unlike 41(1). In 41(1), even successor is subject to tax. But in 41(4), successor is not subject to tax. This is a benefit given in case of amalgamation, demerger, etc. To the successor. That's it. So there is a contradictory view between both of them. In 41(1), successor will be liable to tax. But in 41(4), successor will not be liable to tax as per the Supreme Court judgment. For 41(1), there is no Supreme Court judgment. For 41(4), there is a Supreme Court judgment. Please go through it and then we'll go ahead. This is what deemed income is all about. Now let us go ahead with the next part, and that is miscellaneous issues. The first thing in the miscellaneous issue is section 14A, which talks about if you incur an expenditure for an income which is exempt under section 10 under this act, then that expenditure will not be allowed as deduction. So the expenditure nexus relationship with the income. There is a nexus relationship of the expenditure with the income, and if the expenditure is incurred for an income which is exempt under section 10 under this act, then that expenditure will not be allowed. So how much expenditure will not be allowed? For that purpose, the Government of India has made Rule 8D, and in that there are two parts which are mentioned. Point number 1, point number 2, cumulatively both of them will not be allowed as deduction. Okay. So now this rule will tell us everything about how much will be disallowed. Okay. The first thing is, if an expenditure is directly relating to exempted, suppose if you take a loan directly to invest in tax-free bonds, so that interest will be directly fully disallowed. Fully disallowed. Now, there are certain loans which are not directly invested in the exempt income, but which is invested in exempt income, non-exempt income, cash, stock, debtors, everywhere it is invested. Then what to do in that case? Then you have to use this formula. You have to take annual average, monthly average, 1%. Sir, what are you saying? Let me tell you. You have to identify how much exempt investments you have. Okay. Exempt investment means from which you will get exempt income, exempt interest, exempt dividend. Whatever investments you have from which you are getting exempt interest, exempt dividend, you have to identify that. Sir, identify. Now do one thing. Take monthly average of all of them. 1st April, 30th April divide by 2. 1st May, 30th, 31st May divide by 2. 1st June, 30th June divide by 2. Do that for 12 months. Have we done the monthly average? Yes. Then make a total of all of them. All monthly average add back. You have 12 monthly averages. Add all of them and whatever amount will come divide by 12. You will get annual average. And then whatever amount will come, you take 1% of that. And that will be disallowed in point number 2. Now listen carefully. 1% of the annual average of the monthly average of the opening and the closing balance of the value of investment, the income from which does not or shall not form part of total income. It means you have to take the annual average of the monthly average of the exempt investments and then you have to take 1% of that. Okay, I hope it is clear to all of you. Now, there are certain issues which we need to answer over here. First, CBDT Circular 5/2014, a very important circular. What does it has to say? Suppose I took a loan, and if I took a loan, after taking that particular loan, I have invested that in tax-free bonds. But I have not earned any income out of that tax-free bond in the current year. I'll be earning the income in the subsequent years, not in the current year. But I am incurring the expenditure of interest in the current year. Will the interest be still disallowed? You are taking loan in the current year, you are paying interest in the current year, but you are going to earn exempt income in next year. So will interest be disallowed in the current year if there is no exempt income in the current year, which will come in the future year? CBDT has said that you read the words of the law, and the words of the law says that what is disallowed under this section is interest in relation to an income which is exempt under this act. The law does not say that interest in relation to an expenditure which is exempt under this year. The exemption need not be this year of the income. The exemption under this act has to be there. Is the income is in relation, is the expenditure is in relation to an income which is exempt under this act? Yes. Whether it is exempt in the current year or it is exempt in the subsequent year, it doesn't matter. Moral of the story, what is there? What is the ultimate conclusion of this particular circular? The ultimate conclusion of this particular circular is, if you incur an expenditure for an income which is exempt in the current year or future year, it doesn't matter. The expenditure will be disallowed. Okay. Similarly, one more issue is there in the case of Delhi High Court judgment or in the case of CIT versus Scripco 2012. What does Delhi High Court has to say in this particular case? Now, what are the facts of the case, sir? Assessee has taken a loan and has invested that particular money in a business which is not exempt under section 10 but which is deductible under chapter 6A. Will the expenditure be disallowed? So the assessee is taken a loan for the purpose of investing in a business which is deductible under chapter 6A in the form of profit linked deductions under ATIE, ATIB, ATIC, ATID, ATIE 10 AA, etc., etc. So will that interest also be disallowed? And the answer is no. Delhi High Court said that section 14A is only applicable if the income is exempt under this act. It is not applicable if the income is deductible under chapter 6A. In that case, the interest and expenditure will be allowed as deduction to the assessee. See how minute points are covered in the High Court judgments. Then there is a small section in case of certain assessees like cooperative banks, public sector companies, NBFCs, housing finance companies. This section is applicable to them. To whom? Cooperative bank, scheduled bank, public financial institution, public company, housing finance company. So in that case, there is a special provision which says that whatever they will recognize as bad and doubtful debts, when to recognize income on that bad and doubtful debts. So every bank will have some bad or doubtful debts. So when to recognize the interest income of that bad and doubtful debts. So here it is said that it will be recognized as income in the year in which it is credited to the books of accounts or it is recovered by the bank, whichever is earlier. So till that time, you did not have to recognize every year. It will be recognized when it is credited to the books of accounts or when it is actually received from the customer, whichever is earlier. In that year, you have to recognize that as what? As your income. Till that time, you don't have to recognize that as an income. Okay. And this benefit is only for certain bank and financial institutions. Now let us talk about the next section which talks about maintenance of books of accounts. If you are doing business and profession, you have to maintain books of accounts. So who are supposed to maintain books of accounts compulsorily? For how many years? What will be the consequence if I do not maintain the books of accounts? Okay. So first of all, for that purpose, the government has categorized all assessees into two categories. First is specified professions and other is rest of them. Rest of them will cover other than all specified profession, all businesses, non-specified professions will come in the other category. So specified profession, what will come, sir? Chartered accountants, doctors, lawyers, engineers, IT professionals, company secretaries, film artists, interior decorators. These are the specified professionals. So for them, when is mandatory to maintain books of accounts? If they are existing specified professional, then they have to maintain books of accounts in the current year if their gross receipt is greater than 1.5 lakhs in all the three previous years. If the gross receipt in the last three previous year is greater than 1.5 lakhs, it has to be greater than 1.5 lakhs in all the 3 years, in all. Then only they are liable to maintain books of accounts in the current year. If they are new, if you are a new specified professional, then your gross receipt should be likely to be greater than 1.5 lakhs by the end of the previous year. Okay, then you have to maintain books of accounts. For how many years I'm supposed to maintain books of accounts? You are supposed to maintain books of accounts for a period, you have to keep and maintain the books of accounts for a previous year for a period of 6 years from the end of relevant year. For example, for us, the relevant financial year is 21-22. Therefore, the relevant assessment year will be 22-23. So from the end of 22-23, that is till 31st March 2029, you have to maintain the books of accounts, which is for financial year 21-22, because 6 years from the end of the relevant year. Okay. Now for others, this is for specified professional. What about others? In others, there are two categories. For individual HUF, the limit is alag. For other than individual HUF, the limit is separate. Alag means separate. Sometimes Hindi words might come out of my mouth, so please forgive me. I'm trying my best not to use even a single Hindi word, but still sometimes it comes. Sorry for that. So individual and HUF, what is the limit? Again, there are two categories, whether you are existing or whether you are new. If you are existing, then you have to see two things. If your PGBP in any of the three preceding year exceeds 1,20,000 in case of others and 2,50,000 higher limit for individual HUF, or if your turnover exceeds 10 lakh or 25 lakhs as the case may be. So if you fulfill either of the two conditions, you have to maintain books of accounts in the current year. So because there is an or in between. So if your PGBP exceeds 1,20,000 or 2,50,000 in the last 3 years, any of the 3 years further word any is used over here the word all is used. Then also you are supposed to maintain books of accounts. So in the last 3 years, if in any of the 3 years, if your PGBP exceeds 1.2 lakhs or 2.5 lakhs, Or if this is not getting fulfilled, then if your turnover exceeds 10 lakh or 2 lakh, 25 lakhs in any of the last 3 years, you are supposed to maintain books of account. Similarly, for newly set up business, it is in the current year. You have to check these limits in the current year. That is in the current financial year. What if I do not maintain the books of accounts? I am liable to maintain books of accounts, but I am not maintaining the books of accounts. What will the government do? The assessing officer or CIT appeal may impose a penalty of 25,000 rupees on you. Okay, it may impose a penalty by way of sum of 25,000 rupees on the assessee. Okay, let us go ahead with the next one, and that is tax audit. For whom tax audit is mandatory? Listen carefully. There are multiple categories of tax audit. We have to talk about them one by one. First, if you are doing a business and if your turnover is greater than 1 crore rupees, the tax audit is applicable for you. For businessman, the turnover for tax audit is exceeding 1 crore rupees in the financial year. But there are certain category of people for whom the government has increased the turnover from 1 crore to 10 crore. Who are those special category of people? In previous year, it was 5 crore, but now it has been increased to 10 crore. But this benefit is only for businesses, not for others, not for profession or other category. So if you are into a business, then your turnover limit for tax audit will be 10 crore if you fulfill certain conditions. First, all your receipts in cash has to be up to 5% of total receipts. Means your cash receipt cannot exceed 5% of total receipts. It means 95% receipt has to be online receipts. Similarly, add one more condition. All your payments in cash should not exceed 5%. It means 95% of your payment has to be by online mode, not by cash. Okay. And what does cash include? Cash will include cash. Will cash include bearer check also? The answer is yes. Finance Act 2021 has defined that cash would include bearer check also, because cash would not consider no account pay check. Means you are not supposed to make the payment by cash. Let me tell you very clearly. You are not supposed to make the payment by bearer check. You are not supposed to make the payment by what? By just a cross check. You can make the payment by account pay check. What is written? This is Finance Act 2021 amendment. Last year it was not amended. This year the government of India has clarified that. For this purpose, payment received by check or draft, which is not account payee, means if the payment is received by check or draft, then it has to be account payee. If it is not account payee, then it is considered as cash. Then shall be deemed to be payment received in cash. It means you should not receive the payment by 3 modes. First, cash. Cash will be considered in 5% limit. Bearer check will also be considered in 5% limit. Normal cross check will also be considered in 5%. Rest of the payment which you receive will be considered as your online payment. I hope it is clear to all of you. Now, this is the first category. What about profession? If you are engaged in profession, then the turnover limit is 50 lakhs. It should exceed 50 lakhs, then tax audit is applicable. What about 44 AD assessee? If you are opting for 44 AD, then your turnover limit is not 1 lakh, then your turnover limit is 2 lakh. 2 crore, sorry. Not 1 crore. Because in that case, anyways, up to 2 crore, you are eligible to opt for 44 AD. So here the benefit of tax audit should also be available up to 2 crore now. So let me tell you once again, for business 1 crore, but the 1 crore can increase to 10 crore if 95% of the receipts and 95% of the payment is online. Online would not include cash. Online would not include a bearer check. Online would not include a normal cross check. Account pay cross check, account pay bank draft will be allowed. Okay. Then comes for profession it is 50 lakhs, and for 44 AD assessees the limit of tax audit is 2 crore. What if I do not? What is the due date for tax audit? The due date for tax audit is 1 month prior to the due date of filing of return. So if your due date of filing of return is 30th November, tax audit has to be filed by 31st October. If your due date of filing of return is 31st October, tax audit has to be filed by 30th September. So it is 1 month prior to the due date of filing of return. Okay. What is the penalty? Penalty is given under 271B, and which is very important for exam also. It is 0.5% of the turnover. If you do not conduct, if you fail to furnish a tax audit report on time, then there can be a penalty which can be imposed to the extent of 0.5% of turnover or 1,50,000, whichever is lower. You can check over here. Okay. Now let us go ahead with some issues now. Some small issues which are in respect of expenditure. Listen carefully. Expenditure on issue of shares or debentures or on long-term borrowings. Sir, we have already done this earlier. Where? 35D. Yes, we have done in 35D expenditures in relation to issue of shares, issue of debentures, long-term borrowings. We have done that in preliminary expense. Then, sir, then why we are doing it again? Let me tell you very clearly. 35D is very specific section which talks about, first of all, there are restrictions in that. What if I do not get covered in 35D? Then where shall I go? If I do not get covered in 35D, then where shall I go? Example. 35D talks about very clearly about what? It only covers assessees who are Indian companies or assessees who are resident. It does not cover foreign companies and non-resident. Then what foreign company and non-resident will do if they incur such expenses? Secondly, 35D talks about one more restriction. That is, it is applicable to prior period expenses and it is also applicable to post-commencement expenses. But in case of post-commencement, there is a restriction. It is only applicable if there is an expansion or setting up of a new unit. What about if I am incurring some expenses in relation to share issue, etc. or long-term borrowing in case of my existing business? 35D does not allow you deduction in case of existing business. I hope you should know that. Then what shall I do? Where shall I go? This particular discussion will help you in that. There are 9 Supreme Court and High Court judgments which tells us about these issues. But you should come over here only if your case does not fall under 35D. I have put a disclaimer below. You can see over here. If your case falls under 35D, then do not come over here. If your case doesn't fall under 35D, then come over here. What does these 9 judgments have to say? Let me tell you in one single line. Let me give you a crux of these 9 judgments. These 9 judgments tells you very clearly, if your intention is to raise money, which will be used for the purpose of raising permanent capital in the business, then that expenditure will be considered as a capital expenditure and it shall not be allowed as deduction. Listen these golden words carefully to solve thousands of cases in your life with respect to these issues. These are just 9 judgments. Just 9 judgments. But in practical life, there can be thousands of judgments which will have this particular issue. The entire issues can be solved with the help of this one line. I am again saying, if you are incurring an expense, if your intention to incur an expense is to increase the permanent capital of the company, then that expenditure is capex, capital expenditure, it shall not be allowed as deduction. Let me give you an example. In fact, I'll talk about all 9 of them. First, the assessee intention is to expand the authorized capital of the business. The intention of the assessee is to expand the authorized capital of the business. Therefore, the intention of the assessee is to raise the capital of the business, and therefore, once the capital of the business is raised, it cannot be reduced. Capital reduction is not allowed as per Companies Act. Therefore, it is a capital expenditure, hence not allowed. Second, Brook bond. The expenditure was incurred with a view to increase share capital. Therefore, the intention of the assessee is to increase the share capital of the business. Once the share capital of the business, it cannot reduce ever in life. Till the time the company is existing, it cannot be reduced. Therefore, the expenditure is capex, it shall not be allowed as deduction. Third, the assessee, in the case of General Insurance Corporation, is not raising the funds, in fact, is trying to issue bonus shares. So, in that issue, the assessee incurring some expenditure with relation to bonus shares. Will that expenditure be allowed? And the Supreme Court held that the answer is yes. Why? Because bonus shares does not lead to increase in capital. It is mere capitalization of reserves. It does not increase your overall capital. It does not bring fresh inflow of funds in the business. Therefore, it shall be allowed as deduction. Fourth, if I am raising money through loan, for that I am incurring some expenses, it shall be allowed as deduction because loans will not form part of permanent capital of the business. Next, if I am issuing some debentures on discount, suppose the debentures value is 15 crore, I am issuing at 12 crore. So 3 crore is discount. Will I get the deduction of discount? The court has said yes, but over the life of the debenture, but not in 1 year. Suppose if the life of the debenture is 15 years, it will be apportioned over 15 years. Don't worry. Next, suppose I am issuing share capital because RBI has told me to issue share capital to increase the shareholding of resident shareholder and reduce the shareholding of non-resident shareholder. In my company, the resident shareholders are reducing and the non-resident shareholders are increasing. Now, there is a cap that how much a non-resident can invest in Indian companies. And that is the reason government brings FDI policies. The non-resident shareholding is increasing. So, RBI came into picture and told me, you have to increase the shareholding of non-residents, issue shares to resident. Again, my intention is to raise the shares, to raise the capital. It shall not be allowed as deduction. And if you go through all of them will give you the same picture. I am not going ahead. All of them will tell you the same thing. That if your intention is to raise the permanent capital base of the business, it shall not be allowed as deduction because it is capital expenditure. You are going to get enduring benefit out of it. Enduring means never ending benefit. Till the time the company exists, you will be benefited out of it. Therefore, it shall not be allowed as deduction, as simple as that. Now, let us go ahead with the next one, which is very important. That is presumptive income. Here we are going to see 3 sections, 44AD, 44ADA and 44AE, which talks about presumptive income. First of all, 44AD is applicable to whom? It is applicable to eligible assessees. And who are eligible assessees? Eligible assessees can be individual, HUF, firm, but not LLP, and all of them have to be residents. Non-residents are not covered in this section. Further, eligible business. Which are the eligible business? All business except 44AE. 44AE business is not covered because that is separately covered in the form of 44AE, that is truck wala business, and your turnover has to be up to 2 crore rupees. Then only this benefit is available to you, and your deemed income will be 8% of the turnover. 8% of turnover will become deemed income if you fulfill these conditions. Okay, you become eligible assessee, you have an eligible business, your deemed income will be 8% of turnover. That's it. In some cases, it can also be 6% of turnover. Let me tell you which are those cases. If you receive the money from the customer till the due date of filing of return, you have to receive first of all the money till the due date of filing of return, and you have to receive the money by 4 modes which I have told you. That is account paycheck, account pay draft, such as electronic mode, etc. Whatever I have said you have to receive the money from the customer till the due date of filing of return by 4 modes. Then your deemed income will be 6% instead of what? Instead of 8%. That is a great benefit for you. Now, this benefit of 44AD is not available to certain assessees. An assessee who is claiming deductions of profit-linked nature, profit-linked deduction. An assessee who is claiming profit link deduction, this section is not available. An assessee who is claiming profit link deduction under 10AA or chapter 6A, this section is not available. Payment link deduction can be claimed by the assessee. But an assessee who is already covered in ATI, ATIB, ATIC, ATID, 10AA, these benefits assessee is already taking, that assessee will not get the benefit of 44AD under this section. 44AD is not available to professions also. 44AD is not available to assessees engaged in the nature of commission business, etc. Assessee who is engaged in the nature of commission or bonus business, so commission or brokerage business, not available. An assessee who is covered under any agency business, 44AD is not applicable. These are some of the exceptions where 44AD is not applicable. Once 44AD is applicable, section 28 to 43 gets overridden. If section 28 to 43 gets overridden, because it is written over here, notwithstanding anything contained in section 28 to 43, it means all the provisions of 28 to 43 are not applicable to the assessee. It means assessee will not get any deductions under section 28 to 43, nor any disallowances would be attracted under section 28 to 43. Therefore, let us conclude few things. Whether the provisions of depreciation will be available to assessee? No. Whether the assessee would be liable for any deductions under 28 to 43? No. Whether any disallowance will happen under 28 to 43? Disallowance will also not happen. Whether the assessee will get the benefit of unabsorbed depreciation if it is there? No, because unabsorbed depreciation is covered in section 32 subsection 2. Whether the assessee will get the benefit of reduction of brought forward losses under section 72? The answer is yes, because brought forward losses under section 72 is not covered in 28 to 43. Whether the assessee will get the benefit of ATC, etc., that is chapter 6A payment link deduction, the answer is yes, because what is overridden under this section is 28 to 43. Therefore, the assessee can claim chapter 6A, the assessee can claim brought forward losses, etc., under section 70, 71, 72. All those things are allowed to the assessee. Okay. Now, listen carefully. Whether if the assessee is a partnership firm, whether the assessee will get the deduction of salary, remuneration, interest, the answer is no. It is not allowed. If the assessee opted for 44AD deduction under 44AD, the presumptive income under 44AD will not allow you deduction under 40B, that is of salary, remuneration, interest, will not be allowed to the assessee. Okay. Next. Will the assessee be liable to pay advance tax? Yes, once in a financial year, that is by 15th of March, not 4 times. Generally, an assessee is liable to pay advance tax 4 times in a financial year. But this assessee, special assessee, 44AD assessee will be liable only once in a financial year, that is by 15th of March, 100% tax. Now, serious consequence. Once you follow 44AD, you have to follow 44AD for the next 5 years. And in between of the next 5 years, if you opt out of 44AD, say in the 3rd year, you say, I don't want to follow 44AD. Then after the 3rd year, for another 5 years, government will not allow you 44AD. This is a dangerous provision which is covered over here. So once 44AD, 5 years 44AD. In between, if you do any kind of natak, then for the next 5 years, you will not be allowed to follow 44AD. This is what this provision is all about. Now let us talk about the next one. 44ADA, which is applicable to only specified professionals, which I have told you earlier. Which profession? Legal, medical, engineering, architecture, accountancy, technical consultancy, interior decorator, any other professions may, it comes, film artist also comes, company secretaries also come. So this is applicable to only specified professions, not all professionals. Okay. How much should be the turnover limit? 50 lakhs. How much will be deemed income? 50%. But this section is now, Finance Act 2021 has made an amendment. It is only applicable to resident individual and resident partnership firm not being an LLP. It is not even applicable to HUF now. Till last year, it was applicable to all resident assessees. But now it is only applicable to resident individual and resident partnership firm, not even LLPs. So only 2 assessees are covered. Firm and resident firm and resident individual. Not LLP, not HUF, not company, not AOP, BOI, not cooperative society, nothing. Nobody else will be allowed. Sir, if I do not want to opt this section, can I go to the normal provision? Yes, you can go. Sir, is the restriction of 5 years applicable here also? There is nothing like that. The restriction of 5 years is applicable under income tax law only under 2 sections. That once you follow this section, you have to follow for 5 years. That is under 44AD, and later on it will come under the chapter of MAT, that is 115BBF. 115BBF, it will come later on. I have written over here also. You can see over here. 115BBF. You can see over here. Okay. Sir, advance tax has to be paid by this assessee. Yes, by 15th of the fall March. That is once in a financial year. The rest all provisions are same. All provisions are same means same as 44AD means you will not get any deduction from 28 to 44. No deductions, no disallowances, no unabsorbed depreciation. Yes, brought forward losses you can claim. Then chapter 6A you can claim. Salary, remuneration, etc. If you are a partnership firm, you are paying salary, remuneration and interest to the partner, not allowed. Just like previous section, everything is same. Okay. So the provisions which are same, I am not putting over here. I am just writing over. Rest of the things are same. Then 44A, the third one. This is applicable to assessees who are engaged in flying or hiring goods carriage or leasing goods carriage. Now, this section is applicable to all kinds of assessee, resident, non-resident, individual, HUF, company, firm, AOP, BOI, everyone. Everyone is covered. But one of the conditions of this section is this is only available to small assessee. Small assessee means who does not own more than 10 goods carriage at any time during the previous year. You should not own more than 10 goods carriage even for a single moment in the entire year. Then only this section is applicable. Otherwise, this section is not applicable to you. Okay. Next. The government has categorized all the vehicles into two categories: light motor vehicle, heavy motor vehicle. If the weight of the vehicle, unladen weight, that is without the goods weight, empty weight of the vehicle, without loading the goods, if the weight of the vehicle is more than 12,000 kg, then it is heavy vehicle, and it is up to 12,000 kg, then it is light vehicle. More than 12,000 kg, heavy vehicle; up to 12,000 kg, light vehicle, the unladen weight, without loading the goods weight. That is empty vehicle weight. Okay. Then what is the deemed income? In case of light vehicle, it is 7,500 per month or part of the month. For number of months the vehicle is owned by the assessor. And in case of heavy vehicle, it is 1,000 rupees per ton of the vehicle. If the vehicle's weight is 15 ton, then 15,000 rupees per month, per vehicle or part of the month. For number of months the vehicle is owned by the assessor. So for light vehicle, there is a standard amount of 7,500. But for heavy vehicle, there is a variable amount, 1,000 rupees per ton. The moment the ton will increase of the vehicle, the deemed income will also increase. Okay. So is this assessee, sir, allowed deduction under 28 to 44? No, nothing. Everything is same, but some differences which I have put over here. This assessee has to pay advance tax 4 times in a year, not once. Secondly, this assessee gets the benefit if this assessee is a partnership firm. This assessee gets the benefit of deduction of remuneration, interest, salary paid to partner, but the previous two does not get. That is the reason I have just concluded over here by interlinking the provision. Pay advance tax 4 times in a year. First of all, in 44 AD and ADA, it was only once. Similarly, reduction of remuneration allowed in 44 AD and ADA, it is not allowed. Similarly, here also there is no natak of 5 years. There is no natak of 5 years. Just like 44 ADA. In 44 AD, there is a natak of 5 years. There is an issue of 5 years that you have to maintain, follow this section for 5 years and all those things. Here, you can opt out. If you do not like this section, go for audit, maintain books of accounts, conduct audit, and go for this particular section. It's all fine. Okay. And one last thing over here. After that, I am stopping this session of today's, that is part 2. It has become very big now. And here we will complete the entire business and profession. Okay. One small section in case of insurance business, government has said that if you are engaged in the business of insurance, including mutual insurance company or cooperative society engaged in insurance, your income will be computed as per first schedule of the Act, and first schedule of the Act is not given in your syllabus. It is not a part of syllabus. Don't worry about it. ICI has not put that particular schedule in your syllabus, so we don't have to get into what exactly it is written in the first schedule of the Act. Let me tell you one general knowledge information that after the Income Tax Act ends, there are 298 sections under income tax law. There are 23 chapters under income tax law. After 298 section ends, after 23 chapter ends, there comes 14 schedules which are attached to the Income Tax Act. After the Act ends, there are 14 different schedules which are attached to the Income Tax Act. All those schedules are not part of CA final syllabus. That is the reason I am not talking much about it. But just for general knowledge information, I am saying that after the Act ends, there are 14 schedules in which the first schedule talks about what? The first schedule talks about the insurance business ka income computation. Similarly, I have talked about 11th schedule in what? In 35 2AB in scientific research, that there are certain items mentioned in 11th schedule. If you manufacture those items, then 35 2AB is not allowed. I hope you remember that. This is the interlinking which we are trying to do in the subject, which will be helpful for you all, not only in exam, but also in practical life. Okay. So on this note, I am ending this lecture. I hope you all are liking this lecture. I want your response. I am recording English revision lectures for the first time in my life. I hope I am doing a good job. Generally, I record the revision lectures, which is already recorded for May 22. I have already done the entire session of revision for May 22 and November 22 in Hindi English long back. Maybe first in India. But this time, I am also trying to pass on the benefits to my South Indian students. I don't have much South Indian students, because I have never taught in English. I am going to teach now, because I feel that I should also try to give the benefits of whatever little knowledge I have to the students who belong to the southern part of this country. So with that note, if you like the lecture, spread it to your friends. I want your comments below. That gives me appreciation, that gives me boost, that boosts my morale, and gives me a different kind of energy to further record the lectures for you at an earliest. So God bless you all. Take care. I hope you all are doing good. And if you have any doubts, you can ask me on my WhatsApp number also, 900-900-8977. I'll try to reply at an earliest. You can also join my Telegram channel, see Aarish Khan Direct Tax, or Telegram group, where we are trying to solve the doubts at an earliest. So take care, all of you. I hope you will do great in your life. Take care.